by a record amount. Goldman's golden earnings. The bank posts Wall Street's biggest jump in bond trading so far this season. Revenue at all 4 divisions is up on the year. And Boris Johnson tells EU leaders he's disappointed by progress in Brexit talks. The City of London Corporation urges both sides to avoid an act of self-harm. Matt?
Take a look at futures right now. Speaking of, well, I don't know if you'd call it self-harm. In any case, investors are selling off futures contracts on all of the major European equity indexes. DAX futures are down 1.25%. So not only are they off, but they've been going lower throughout the session. You could see a fairly volatile section. Take a look at the GMM screen, the global macro movers screen. You've got a risk asset here in each column. On the far left-hand column, you'll see these numbers populate as the index is open live. The FTSE, as usual, the first to open up, down right now about 0.5% and falling. So you could see these numbers continue to get worse. In terms of the other European equity indexes, they all open up later than the FTSE, but when there are strong moves in one direction or the other, it takes a little bit longer for them to open up. Here you can see this Spanish IBEX in Madrid out of the gate down 1.25% as the FTSE falls more than 1%. So European equity indexes looking like they're going to be down about 1% or more. That's as London is set to follow Paris with stricter virus measures, and new cases in Germany hit a record. Don't forget about the fact that the U.S. Doesn't look like it's going to get a stimulus package before the election. Joining us now is Grace Peters, J.P. Morgan Private Bank Managing Director and Head of European Equity Strategy. I almost forgot the other big piece of news, Grace, which is that Brexit looks like it could go no deal, or at least Boris Johnson has to kind of massage his previous statements in order to continue negotiations. With this triumvirate of bad news, does it make sense to you that investors are selling stocks today?
Good morning. Thank you for having me on the show. Our view is that we are in the midst of a recovery, and as such, equity markets are going to move higher over the next 12 months. Specifically, we think that US and China equity indices can make new highs over that 12-month period. But of course, we're going to see periods of volatility and market consolidation through that. And this is what you're alluding to here, that the shape of the COVID virus resurgence, lockdowns that ensue thereafter, and obviously other political events. But we would be using these periods of volatility and consolidation to add cyclical exposures, to supplement areas of structural growth. We've been long-term advocates of many secular trends, including digital transformation via the technology sector. Our conviction in that hasn't waned, but we do find new opportunities opening up, particularly as a result of structural changes that have taken place in a post-pandemic world. And it's in these new areas that we see actually some of our highest conviction equity ideas. In terms of what we're looking for, and when we invest in these new areas of growth, we're looking for durable change that's resulted because of the COVID pandemic. So that's essentially new revenue opportunities. We're looking to invest in alignment with fiscal supports that we've seen so that that growth can be stronger, but also more secure. And we're also looking closely at flows, parts of the market perhaps that are under-owned or that can benefit from secular flows from ESG that we believe in.
It's interesting to look at where the markets are this morning, Grace. You wonder what is driving this particular wobble, this bout of a lack of confidence. But the FTSE 100 down 1.4%, the CAC yet to open, the Xetra DAX down 1.5%. Is this nervousness around the extent to which we're going to see our movement limited, our freedoms curtailed over the winter months as governments in Northern Hemisphere countries really try to deal with another wave of this virus, and the fact that these curtailments on movement could be long-lasting, even if they are not as draconian as they were the first time around?
Yes, and you've certainly seen in the economic data, as that's ebbed and flowed, you have seen evidence that when the virus has resurged and lockdowns have ensued, that has impacted the economic data, particularly in those high-touch sectors. So I think the market is concerned about that. What we see is that the shape of the additional restrictions coming in are much more focused with the intention of limiting the economic fallout. And that's very different from what we saw through the spring, when it it was just a blanket lockdown with, the total focus being on controlling the virus. So I think that is a concern for the market. But as I say, I think that this actually provides opportunity to buy into some of the themes that we've liked for a while and some of these new themes. And we call this investing for a durable recovery, because as I say, we do think that we're in a recovery that's obviously not going to progress in a straight line, but durable trends, and we think specifically around clean energy, e-mobility, and infrastructure spending as well, are really where we want to be putting capital to work.
Yeah, I was just going to ask if you can take advantage of these sell-offs to buy the dip, Grace, because, people are so quick to say London lockdown, and maybe it won't really be a lockdown. I mean, pubs closing at 11, that should be the normal state of things anyway. I don't know when they decided to stay open later than that, but isn't it possible that the markets are a little bit too concerned on a day like today?
I think, the markets have obviously traveled a long way from March, so it's natural that you get volatility coming in around some key events. We've obviously also got the US election that's driven markets and an optimistic mood, I think, increasingly in recent weeks. And you've got the virus resurgent coming in, and the worry for investors is that this moves away from being just hotspots to being something that's broader. But we think the virus will be well contained, and within that, the economy, can continue to do well. And whilst we expect a recovery in the economic data and therefore corporate profits and therefore financial markets, the shape of that recovery, what's happening underneath, will be quite different. When we think about the high touch sectors, travel, leisure, hospitality, that's now quite a small part of GDP in the single digit range. And obviously you've seen technology play a greater role in that. Home improvement is another strong trend. So whilst the shape of what's happening below the surface has undoubtedly changed, we do still feel very optimistic that we're in the start of a multi-year cycle, and therefore that we will see progress, and particularly around the equity opportunity pertaining to some of these longer-term trends that I've mentioned.
Where do you position in tech right now then, Grace? Because we heard from TSMC this morning, they were citing digital transformation, the speeding up of that digital transformation, of course, and drivers towards 5G, their relationship with Apple, clearly very helpful for them at this point as well. Where are you investing in tech?
I think the digital transformation is still a place that's extremely interesting, because it's easy to say that it's done. That we had the pandemic, we all jumped to work from home, and therefore you've had that step change, the pull forward of CapEx, and the stocks have gone up accordingly. We don't believe that's the case. What you've seen through the COVID pandemic and technology is proof of concept, bringing forward of those trends, but we think that's just to a new level from which you'll see a further acceleration. Obviously, the amount that a corporate can spend on technology is directly correlated to that corporate's profits. And we're seeing, as we're going to hear more through the third quarter earnings season, while we think earnings can come in ahead of expectation, let's not forget that corporate profits are still down some 30-odd% year on year. And as we go through that economic recovery that I mentioned that we believe in, corporate profits will grow, which means that the ability for a company to spend absolute dollars, but also a higher percentage of dollars on technology and digital transformation will rise. So we agree with 5G as being a key trend, artificial intelligence, another one, the Internet of Things. All of these drive greater connectivity, which increases resilience.
We'll get to some of those other themes in our next conversation. Grace, thank you very much. Stay with us. Grace Peters, JP Morgan Private Bank Managing Director and Head of European Equity Strategy. More from Grace in just a moment. Coming up after strong earnings from Goldman Sachs, all eyes turn to Morgan Stanley. We preview the lenders' third quarter earnings. We'll get a rundown of what to look for in these banks reporting. This is Bloomberg.
originations have been down below analyst expectations up and down the street. Our charge-offs were 29 basis points in the quarter, which mirrors the best of times. And so while we're not out of the woods because there's still uncertainty in terms of the path of where things could go, it does feel a lot better than it did a quarter ago.
That was Wells Fargo's CFO, John Shrewsbury, speaking to Bloomberg after the bank's profits slumped 56%. Now investor attention turns to Morgan Stanley, but will the figures disappoint like most of the rest of lenders' results? Joining us to discuss is Danny Berger. So Danny, given what we've seen so far for big bank earnings, how are Morgan Stanley's results likely to size up?
Matt, the bar is set really high for Morgan Stanley to impress. We've seen basically every lender's share price fall after reporting, save for Goldman Sachs. So that's sort of where the standard has been set. Part of Goldman's success had to do with this huge increase they had in trading, specifically FICC trading. Were a little bit weaker than expected in equity trading. So this is really where Morgan Stanley could shine. There's its estimate. If it can just meet where the consensus is, it will become the #1 bank in terms of market share for equity trading. So any gains on that will be taken positively by investors. Goldman Sachs is also pretty bullish on their M&A and deal outlook. So if Morgan Stanley echoes that, that will obviously be taken as a positive as well. But again, investors very skeptical of what they're hearing from banks, and no doubt will be very crucial and critically looking at Morgan Stanley's earnings.
I don't want to lead the witness, Danny, but the chart we're showing right now suggests that Morgan Stanley it goes alongside some high expectations. We are expecting something pretty strong from them. So what commentary should we look for from Morgan Stanley executives today?
I think the commentary is really key for all of these earnings because, look, the banks have come out with much smaller loan loss reserves than had been expected. In some cases, less than half of what was expected. But investors haven't really cared because of the commentary they've been getting from these executives seems to indicate that this is just a pause in some of the bad debt, not necessarily a complete end to the turmoil that we're seeing in markets. So they'll surely want to know Morgan Stanley's outlook on that. Assuming that, much like the other banks, they have lower loan loss figures. They'll also want to hear from executives about their various deals they've had. Morgan Stanley coming fresh off the back of 2 mega deals, E-Trade and Eaton Vance, much more retail-focused businesses. So it seems like Morgan Stanley is taking their asset management unit in a different direction. That surely will be a hot topic of conversation in the earnings call. Matt, Anna?
Thanks very much. Danny Berger there with a look at what to expect from the banking sector. Let's look at some more investment themes with Grace Peters, JP Morgan Private Bank Managing Director and Head of European Equity Strategy. I want to step away from the banking sector and actually look at something that jumps out from your notes, Grace, and that is around utilities. And I mentioned this because we've had a number of guests recently talking about how an area that had previously been considered not all that exciting suddenly is much more exciting and to the fore. We've got a chart that pulls up Ørsted, a Danish utility, wind power focused. We could have chosen other established wind power players, though, to make the similar point. And you've pointed out how in this sector as a whole, we see EV to EBITDA, the ratio of that looking very positive, as if a re-rating of this sector, of the established players, has already happened. Is there still room to play this theme then, away from Ørsted specifically, in the sector as a whole?
I think this is absolutely fascinating because you're right that utilities has moved from an ex-growth sector to one where we see a multi-year organic growth story just starting to unfold. You have pure plays within the utilities sector that have achieved a higher rating. But those pure plays perhaps didn't start out as pure plays. They've undergone a transition themselves, and we think that others in the sector can follow suit. So as businesses become more focused on renewable energy, most notably wind and solar power, as they divest of dirtier parts of the business, then we think that they can not only achieve this higher organic growth, but also the equity re-rating. And therefore, for us, this is one of the most compelling sectors to invest in. European utilities, I would argue, were ahead of the US utilities. Obviously, the outcome of the US election could change that and actually see there's a bit of a catch-up trade in US utilities as well. But for the sector overall, this very much feeds into the energy transition and some of these environmental themes that we think provide particularly compelling investment opportunities.
What are the other outcomes that you think could be different in in case of a Biden win. I assume that's what you're referring to, Grace. Just wanted to pick up on that thread really quickly. If there is a blue sweep, so to speak, what do you expect?
So if there's the blue sweep, then the energy transition is one thing that will benefit. But I think more environmental trends broadly will benefit. So that also feeds into e-mobility. We think not just when it comes to passenger electric vehicles, but also freight, in terms of that being a big contributor to greenhouse gas emissions. And infrastructure would be another piece. And there's so many facets to infrastructure. There's the physical infrastructure to do with aging roads, bridges, and many of those things that have been long discussed. But there's also renovation. We see a renovation wave about to unfold across Europe, driven by the EU Green Deal. And again, that could start to translate into the US market under a Joe Biden win. And then digital infrastructure is also a key part of it. We touched in the last segment on 5G, Internet of Things, industrial, artificial intelligence. All of these digital transformation themes need infrastructure in place to facilitate that development. So infrastructure as a piece is interesting and certainly could be accelerated under the Democratic sweep.
I see. So, but it would take quite a lot of power in the hands of one side to push through some of this infrastructure, would it, Grace? Because we seem to talk about infrastructure often, but then maybe it doesn't always come through on delivery, and you wonder whether 4 or 5 years as a political time horizon is enough to commit to some of these big infrastructure projects. Should we have different hopes, different expectations as we head into next year?
I believe so, and I think also the COVID pandemic has put a different tilt on things. When governments are looking to invest to stimulate economic growth, there's really two things that they're trying to achieve. Firstly is obviously increasing employment, but also it's the strategic objectives, and part of that is an equitable recovery. So I think infrastructure is a good way to spend to increase the chances of a more equitable recovery. But we also need to see investment in our cities to make them more resilient, to make them more environmentally friendly. So when you put all that together under the umbrella of infrastructure, then we think that there's a very, very firm need for it, and an accelerated need that we hope will result in a real commitment from governments in the US, particularly under the scenario where you get a Democratic sweep.
How encouraged are you by the so-called Hamilton moment, the EU Rescue Fund? Yesterday, Olaf Scholz told me they expect to be ready to disperse the money by the end of the year. Is that a huge vote of confidence in European stocks?
I think that it's helpful to European stocks. I mentioned in the earlier segment, we think markets will move up. That's driven by the US and China making new highs. Europe, we think, is going to lag the global recovery, but still make positive progress. And the EU Green Deal and the capital commitments that we've seen there certainly is very helpful. I would say that it's helpful to the European market overall, but I would say it's a real catalyst for some of the sectors that we've spoken about, not just utilities, but also autos, construction, material, and if we go back to what we're trying to achieve overall as we invest in this recovery, it's investing in secular growth but adding cyclicality. And so when you put the EU Green Deal and look at the sector exposures that gives you when you do your bottom-up stock analysis, then many of those sectors we think mean that your portfolio overall has this attractive balance of secular growth but also the cyclical exposure, where, as we expect to see through the third quarter earnings season, you start to get revenue moving ahead of costs, meaning you get nice operational leverage into that recovery.
Thanks very much, Grace, for joining us. Really appreciate your input this morning. JP Morgan Private Bank Managing Director and Head of European Equity Strategy, Grace Peters. She'll continue the conversation with Anna and myself on Bloomberg Radio at 9 a.m. UK time, 10 a.m. here on the continent. To tune in, just Google it. Bloomberg Radio. It's very simple with the internet these days. Coming up, Europe's virus resurgence. France imposes a curfew in Paris and other major cities. Germany hits a new record in infections, but here they just say, please stick to the rules. We'll give you all the latest next. This is Bloomberg.
Welcome back to the European market open. 24 minutes into your trading day just, and you can see that European equity markets are not taking the latest news around the virus in their stride. Stocks around Europe down by 1.8%. We're down by more than 2% on the London market, so the FTSE 100 down just over 2%, and the Xetra DAX similarly down by 2.2%. So that's where we see the biggest falls coming through. And we have had virus numbers in Germany that give us something to think about, the highest in the virus story so far for Germany, and concern in London around further measures to tighten up on movement and contact within London. Europe is then intensifying its efforts to stem an unrelenting virus resurgence. Some of the strictest measures came from France overnight. The country is imposing a curfew in Paris and 8 other major cities. Germany, as I mentioned, has also seen a record number of cases. That's after Chancellor Angela Merkel has warned more measures will be taken if the rise in infections doesn't stop in 10 days. Joining us now, Bloomberg Intelligence Director of Research, Sam Fazeli. Sam, the debates rage on, it seems, in various parts of Europe as to the best way to tackle the virus at this point, as we see it in its second coming, if you like. What are your thoughts on the idea of a circuit breaker? That seems to be something that was in the narrative here in the UK a while back. Maybe it's been pushed to the side by the current administration. But what is the point of a circuit breaker that then when you lift it, you get back to where you go back to where you started?
Anna, that's an excellent question. And honestly, the only way we can tackle this is if people's behavior in general, not just driven by circuit breakers, etc., changes. And unfortunately, I think that's what this virus resurge is telling us, that people's behavior is not necessarily in tandem with what is required to stop an airborne respiratory virus. And circuit breakers will help if you're trying to manage the impact on the healthcare system, or just keep resetting and starting from scratch every few months until you have a vaccine. But I can't see anything long-lasting from that perspective.
We're going to have to call a circuit breaker right now. Unfortunately, Sam, we're out of time, but I appreciate you stopping by, even if just for one question. We hope we can get you back on soon. Sam Fazeli from Bloomberg Intelligence there, talking to us about the possibility or the effects of the efficacy of a circuit breaker lockdown. Up next, Boris Johnson tells EU leaders he's disappointed by slow progress on Brexit talks. Ursula von der Leyen tells the Prime Minister there's still a lot of work to be done.
Welcome back to the European Market Open. 30 minutes into a trading session that's broadly negative for European equity markets. We're down by more than 2% on the Xetra DAX right now. The FTSE 100 not far behind as well. In terms of the worst performing sectors, travel and leisure once again to the downside. Autos and parts, insurance not doing all that well either. Travel and leisure being weighed down by that news we got from Ryanair. That is having an impact on other airlines in that space. Ryanair cutting its capacity for the winter. Let's get a Bloomberg First Word news update. Here's Laura Wright.
Thanks, Anna. Singapore and Hong Kong are set to create a travel bubble. It will exempt people from both cities from quarantine. The move reopens links between Asia's two top financial hubs. Singapore says it hopes the bubble will start within the next few weeks. The news is helping air carriers in the region, including Cathay Pacific and Singapore Airlines. The chances of Congress passing a stimulus package before the election are now all but gone. Treasury Secretary Steven Mnuchin is blaming politics for undermining the months-long negotiations. The White House has criticized the Democrats for stymieing the rescue plan, but Democrats have hit back, saying the administration did not take the need for more stimulus seriously. Thailand has declared a state of emergency in the capital, Bangkok, as protests against the government continue. Yesterday, tens of thousands of protesters broke through police lines to march on the Prime Minister's official office. Protesters want new elections, constitutional reform, and curbs on the traditional powers of the king, but they say they do not want to bring down the monarchy. Tensions are rising between Armenia and Azerbaijan. For the first time in 2 weeks of fighting over disputed territory, Azerbaijan says it's attacked military installations inside Armenia, which warns it may retaliate. This latest development threatens to bring Russia more closely into the conflict. It has a mutual defense pact with Armenia and says it's studying the incident. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, Matt.
Laura, thanks very much. Laura right there in London with your first word news. Now, Boris Johnson tells European Union leaders he is disappointed by the slow progress on Brexit trade talks. The British Prime Minister says he will decide after this week's EU summit whether it's worth continuing to work for a deal or not. German Finance Minister Olaf Scholz told me that he expects both sides to seal a deal, even if it comes at the last moment.
It is always the right way to discuss questions that are difficult up to the last moment. And my experience is sometimes in the last moment you will find a solution.
Ursula von der Leyen had a phone call with Boris Johnson. In a tweet after the conversation, the EU Commission President said there is still a lot of work ahead on fisheries, level playing field, and governments. Joining us now is Jenny Revis, EU Competition and Trade Practice Partner at Baker McKenzie. Jenny, thanks for your time. Let me just first off ask, how could there be a lot of work left on fisheries? I mean, it seems so simple and economically so insignificant.
Good morning. Well, absolutely. I mean, fisheries, you might not think could be such a hot potato, but it is a political hot potato for a number of different reasons. President Macron in France is up for an election in 2022, and the northwestern part of France is an area that relies heavily on fisheries for the economy. And therefore, President Macron will want to ensure that he has the support of that part of the electorate. And in order for them to be able to continue their activities, they consider they need access to part of the UK's fisheries waters. If they don't have access as they currently have, being part of the single market, that means they'll be constrained to French fishing waters, and they say they will not have sufficient access to fishing because other European member states would also be accessing French fishing waters. So it is indeed quite a hot potato in Europe at the moment.
And of course, from a UK perspective, this given extra prominence, perhaps, Jenny, because of pressure for another independence referendum in Scotland and the size of the fishing industry, or the visibility, at least, of the fishing industry there, promises that have been made to that industry, and an aim in Whitehall, no doubt, to hold the union together. Jenny, though, let me ask you about the difference or the delta between deal and no deal, because you say in your notes ahead of our chat today that the difference isn't actually that great. Is that because services is not included, or is it, even if you strip away the services exclusion issue, is there still not that much difference? Because for some industries, there's a huge difference.
right. I think it depends on which industries you're looking at. So our research with Oxford Economics, a leading analytical company, lobbying company, looked at exactly this issue, and we found that a free trade deal with the EU would see UK GDP fall by 3.1% in the next decade, as compared to a no-deal situation where the drop in GDP would be 3.9%. So you can see the delta between the two is not that significant. But in practice, if you drill down into these figures, the benefits of a deal will be more significant in certain sectors versus others. So having a deal will be very important for manufacturing sectors in the UK, such as the auto sector, or sectors such as healthcare that rely heavily on regulation of products, and having some mutual recognition between the EU and the UK will be fundamental for those industries. The challenge you have with the free trade agreements, or at least the more traditional free trade agreements, is they provide for free trade primarily for goods, and typically there's less in the way of access for services. And that's a key concern for the UK, because the UK is a heavily services-focused industry, and therefore, particularly for areas such as financial services, we will need to ensure that there is access to the EU market, and therefore the free trade agreement will need to go beyond the traditional free trade agreement to capture services as far as possible. And at the moment, with the way the negotiations are going, there are concerns that that free trade agreement may not go far enough to cover that.
Jenny, do all outside countries that make trade deals with the EU have to agree to have state aid issues decided by the EU's Court of Justice? Or would it maybe be, is it more typical to have a third party deciding such issues? It seems like it would be more fair to have a third party than to have the UK still subject to EU law.
Yes, absolutely. Most free trade agreements provide for a dispute resolution process that's specific to that free trade agreement, which would be an independent body of both parties that would look at these types of issues, as opposed to a dispute resolution body of one of the two parties. So from the perspective of the UK government, it would be absolutely unacceptable to have to rely on the supervision of the European Court of Justice to decide any matters pertaining to trade in the UK. And that's why we still have a delta in terms of how dispute resolution will be resolved when it comes to matters under the EU-UK free trade agreement. I think the state aid issue is a slightly different one. The concern here of the EU is that with the UK leaving the European Union and having more freedom over its policies, such as state aid and what subsidies are provided to boost the UK economy, that the UK may depart from the state aid rules they've been abiding by since they've been part of the European Union, and therefore UK businesses may be given, in the EU's view, an unfair advantage. UK businesses may be given over the EU businesses an unfair advantage. And the EU therefore is making it conditional on the UK retaining access to the EU single market for matters such as goods, etc., but the UK continues to abide by EU state aid rules.
What about the rules of origin and how much of a stumbling block that still is, Jenny? Because you've made the point that a free trade agreement is only free to the extent that you comply with the set out rules of origin within that agreement.
And that's a really, really important point, because free trade, as you said, doesn't mean free trade. It means that goods that qualify as originating in the free trade agreement partner countries, so here the UK and the EU if the deal is reached, but would qualify for duty-free treatment. It's expected at the moment that the rules of origin that would apply for movements between the UK and the EU are the rules of origin that are set out in the Pan-European Mediterranean Convention, which is a free trade agreement that the EU currently has with numerous countries around the Mediterranean region, such as Morocco. And so at the moment, because it's so complex to negotiate rules of origin, you have to go through products line by line, rather than have that negotiation at the moment, and there is no time for that. the UK and EU would agree to apply the same rules of origin as are already in place with other third countries. But those rules are typically difficult for companies to apply, and they rely on minimum originating content being used. So that's been raised as a specific issue and concern for the auto industry, for example, because the auto industry would use parts from third countries such as Japan, Switzerland, and it's been very clear in negotiations with the EU that the EU will not accept parts from other countries, even where the UK and the EU have free trade agreements with those countries, will not allow those parts to be treated as originating. And that's what we call the concept of accumulation, where if you have a network of free trade agreements, you can look to use parts and materials from other countries and count them as if they were UK or EU.
Okay, thank you very much. Thanks for the briefing. Thanks for the briefing, Jenny. Clearly a bit of a headache still, this particular issue. Jenny Revis, EU Competition and Trade Practice Partner at the firm Baker McKenzie. Up next on the programme, we'll be speaking to the Roche CEO, Severin Schwan. That's after the Swiss drug maker reported sales that came in a little below analyst estimates. We'll ask him what's happening with the biosimilars. This is Bloomberg. Welcome back to the European market open, 44 minutes into a negative trading session for European equity markets. You can see we're down by 2.4% now on the Xetra DAX, and the FTSE 100 not far behind. One stock that is moving to the downside is Roche. Roche third quarter sales coming in lower than had been anticipated. A decline from its prescription drugs overshadowed a boost from COVID tests. The Swiss company reported sales of 14.7 billion Swiss francs. That is, as I say, below the average estimates. Joining us now is the Roche CEO, Severin Schwan. Very good to see you, Severin, on the programme once again. The competition that you face from biosimilars right now has surprised perhaps some in the market. How are you able to confirm your guidance, even though the competition from biosimilars seems quite intense?
Indeed, the competition from biosimilars is intense, but this was expected. And what we have seen over this year is a decline in the second quarter due to COVID-19. But the good news is the business recovered in the third quarter, and that was primarily driven by our newly launched medicines. They actually compensate more than the loss we have from biosimilars, and as you say, a very strong demand for COVID-19 tests.
How much of a recovery did you see in the third quarter in terms of doctor's office visits, Severin? I can imagine, you know, the doctor's office is a place a lot of people are avoiding right now. That must also be a problem when it comes to prescriptions. What kind of rebound did you see, and what kind of behavior you expect from patients in Q4?
You're absolutely right. This was exactly the consequence of the lockdown in the second quarter, that patients delayed their doctor visits, they delayed their hospital stays, and as a consequence, of course, there was an immediate impact on our business, both the pharmaceutical business and the routine diagnostics business. Now, we have seen a recovery already in June, and roughly we are back now at about 90% of capacities. So patients are not yet returning to their doctors and to hospitals. At pre-COVID levels, it's at about 90%.
And how long do you think that the treatment rates, Severin, for chronic diseases like eye disease, multiple sclerosis, how long do you think they'll get back to normal?
As far as our portfolio is concerned, actually we have seen a very good recovery. If you look at Ocrevus, for example, multiple sclerosis, a chronic disease, we are actually back in Q3, and that is Ocrevus and other medicines. That is really the reason why the business recovered in the third quarter, why we had good growth in the third quarter, and that's also the reason why we are confident to confirm our outlook for the full year.
I got to ask about the antibody cocktail that you are developing together with Regeneron. First off, how do you go about seeking European approval for this treatment, for this COVID treatment?
The status as of now is that Regeneron has filed for emergency use authorization in the United States, and we are in discussions with Regeneron to also seek approval outside of the United States. So this is at an earlier stage, but of course we want to make sure that we bring this treatment option to as many patients as soon as possible, also outside of the United States.
In the United States, I noticed President Trump gave the treatment a big thumbs up. He promised American citizens they would all be able to have access for free. Are you aware of exactly how that's going to happen? Have you talked with U.S. officials about this?
We have not yet started any pricing discussions with governments around the world. Our focus for the time being is really to provide supply at this stage for conducting the confirmatory clinical trials and then ramping up supply as we bring this medicine to the markets. That's what we are focusing on. But rest assured, like in the past, we will be very thoughtful regarding our pricing and make sure that access is possible for patients around the world. Our focus really, and the bottleneck at this stage, is building up the capacities.
Severin, you've been suffering from some shipping delays in your UK operations surrounding COVID-19 and testing. How far along the process to clearing that up are you?
It's cleared up. We provide, again, full supply for our different diagnostic offerings, so that we are again back with normal supply.
Are you completely prepared for a no-deal Brexit? I mean, we've heard so much talk about trucks lined up, issues getting things back and forth to the island. Do you think that's going to be a concern, or have you got plans for that?
We have, of course, prepared ourselves and we have contingency plans that has a lot to do with bringing enough goods, medicines and diagnostics to the UK. So I'm confident that we can keep a continued supply going.
Severin, thanks very much for joining us. Roche CEO Severin Schwan talking to us about earnings, competition, recovery from the COVID virus, and recovery from the lockdowns, I should say, and what's going on in the United States with President Donald Trump. Now, up next, a wave of corporate bankruptcies has only been deferred. It can still flood financial markets in the coming months. We'll discuss this macro view with Laura Cooper, Bloomberg's MLive macro strategist. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 53 minutes into the trading day. The DAX is down 2.3%. Big drop there. The FTSE off 108 points. And the CAC 40 down 1.7%. Joining us now is Laura Cooper, Bloomberg's MLive macro strategist. And Laura, looks like we're seeing some big sell-offs today on concerns, I guess Brexit and stimulus for sure, but this must be mostly COVID focused.
Oh, absolutely. And I think just the fact that we are seeing European markets deep in the red while U.S. futures are only slightly on the back foot does signify that this is really concerns about the virus resurgence. So clearly the fact that the DAX is leading the drop does the signal that, we did have Merkel come out saying that the country really can't handle a repeat of the fallout of the initial lockdown that they saw earlier this year. So the fact that we are seeing renewed restrictions likely coming into place is clearly weighing on risk sentiment, as this positive growth narrative that has really held in place for the past several months is really starting to fade, and fade quite quickly.
Have we given up, good morning to you, Laura, have we given up our obsession with stimulus stateside, given what we heard from Treasury Secretary Mnuchin this week? I say give up, I guess I mean before the election. After the election is a different story, and we're not far away from it now.
I mean, I still think, there is this wide gap that remains between what the Democrats are offering, what the Republicans are willing to accept. And clearly, investors, I think, are more shrugging off just these fears that we won't actually see a stimulus package ahead of the U.S. election. If anything, we are seeing these bouts of volatility on investor jitters. But ultimately, the case remains that we will see a sizable fiscal package regardless of the party who wins on November 3rd. And that's continuing to kind of buoy sentiment, despite kind of these bouts of frictions that we're seeing come out of Washington.
Well, you say, now you've been in London long enough that you say boy, but we know it's buoy. In fact, I believe it's spelled buoy specifically. In any case, I wanted to quickly ask you about the wave of bankruptcy. You've got a macro view out on that today. I guess we were expecting this, but didn't ever see it. It still could come.
Well, it is the case that, we did see this exceptional stimulus come from central banks. We did see government intervention that was unprecedented, that really did defer this flood of bankruptcies that normally one would expect, given the economic collapse that we saw earlier this year. But as we see renewed restrictions come in place, as we see economies really struggling to return to those pre-pandemic levels, that does suggest that this wave of bankruptcies will still come into play.
Laura, thanks so much. Laura Cooper, Bloomberg Markets Live macro strategist. Surveillance is up next. Nothing is buoying these markets this morning. This is Bloomberg.
The second wave strikes Europe after a curfew in Paris. London is said to see tighter virus measures. In Germany, new cases rise by a record amount. No deal. Steve Mnuchin downplays chances of fresh stimulus ahead of the election. Nancy Pelosi says the White House offer remains significantly short. There are 19 days until the vote. And Brexit roundabout. Boris Johnson seems willing to overlook his self-imposed Brexit deadline. Germany's finance minister tells Bloomberg a breakthrough could happen at the last moment. Well, good morning, everyone, and welcome to Bloomberg Surveillance. We're certainly not short of news today. I'm Francine Lacqua here in London. Now, the focus, of course, is on the markets because we're expecting quite a lot of earnings. We had banks. We have, of course, Roche coming out with earnings. And then a little bit later, we have some of the U.S. stocks. The other thing I'm looking at, of course, is pound on the back of this Brexit deadline. Remember, it was a self-imposed deadline of October 15th. Guess what? We're October 15th, but actually Brexit negotiations are still continuing. If you look at some of the earnings, look, they reignited a bit of concerns about the number of cost cuts and the number of job cuts. At the same time, prospects wilting for this new stimulus from D.C. before the November election. And so you can see European stocks down 1.7%. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. UK Prime Minister Boris Johnson is disappointed by the slow progress of Brexit trade talks. In a call with EU leaders, he said he will decide after this week's key summit if it's worth continuing to work for a deal. He had previously indicated the UK would walk away if no agreement was in sight by the 15th of October. Germany is still optimistic a deal can be reached.
It is always the right way to discuss questions that are difficult up to the last moment. And my experience is sometimes in the last moment you will find a solution.
Over in the US, President Donald Trump has hit out after Facebook and Twitter put restrictions on an article about his election challenger, Joe Biden. The New York Post story says emails from his son, Hunter Biden, show he introduced his father to a Ukrainian energy executive, claiming it contradicts Biden's earlier denial. Facebook says fact-checkers are now evaluating the article's authenticity. And Thailand has declared a state of emergency in the capital, Bangkok, as protests against the government continue. Yesterday, tens of thousands of demonstrators broke through police lines to march on the Prime Minister's official office. Protesters want new elections, constitutional reform, and curbs on the traditional powers of the king, but they say they don't want to bring down the monarchy. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, Europe is intensifying its efforts to stem an unrelenting virus resurgence. Some of the strictest measures came from France. The country is imposing a curfew in Paris and to 8 other major cities. Now, Germany has also seen a record number of cases. That's after Chancellor Angela Merkel warned Germany's economy cannot handle a second wave. Now, for more, Bloomberg's Western Europe managing editor Chad Thomas joins us with the very latest. Chad, record cases. How much more pressure does this put on Angela Merkel?
Well, good morning, Francine. Angela Merkel is under a lot of pressure to do more here in Germany. One of the challenges that she faces is Germany, of course, is a federal system. That means that a lot of these decisions are up to state leaders. She was clearly very frustrated last night. She met with state leaders for 8 hours yesterday, and when she came out and gave her press conference late last night, she basically said, look at what France is doing. France is putting in place a curfew, and she's really struggling to get any sort of agreement out of these leaders. She put her chief of staff on the radio today here in Germany, and he basically said Germany is on the cusp of a second wave, and if we don't act now, it won't only have health effects, but effects on the economy as well. So we'll be watching very closely to see how this continues to play out here in Germany in the next couple of days. But right now, the new measures that they've put in place have been very piecemeal, to say the least.
Chad, you know, what's fascinating and terrifying at the same time is that it's really up to a leader to decide what approach they take. And if you look at UK, France, and Germany, they're just taking very different approaches to how to beat the virus.
Yeah, I think the real challenge is, Francine, is all of these countries went through very strict lockdowns in this first wave. they took huge hits to their economies, and now they're all trying to find their way. How do we move forward without having another complete lockdown? Because Merkel said herself yesterday that the economy can't afford that. And so they're all trying to find their way. In Germany, for example, they decided to close restaurants from 11 p.m. in hard-hit areas. But there was an effort to tamp down on domestic travel in Germany. We're in the fall holiday season for schools here, and basically state leaders told Merkel yesterday, no, we won't do that. We're going to let people travel within Germany. So it really is sort of taking stabs here in the dark, trying to get this under control.
Chad, thank you so much. Chad Thomas, our Western Europe managing editor. Now let's get to the markets. European equities sliding this morning. The STOXX 600 heading towards its biggest drop in 3 weeks. That's after corporate earnings, in some cases, failed to excite, but also we had this prospect for new U.S. stimulus dimming ahead of the election. So for more on the markets, let's get straight to our Danny Berger. Hi, Danny.
Hi, Francine. The picture coming from markets today is definitely one of that concern over the picking up of coronavirus case counts throughout Europe. And Germany, really one of the biggest decliners here, falling more than 2.5%. Both Germany and Italy recording record numbers of new cases this week. Also seeing France putting on more restrictions, as Chad was talking about. And you can really see that reflect through this bid for more haven assets. Angela Merkel herself said that they have to control the coronavirus, so it wouldn't be unreasonable to think that we get more restrictions throughout Europe, perhaps London also heading for a shutdown. So the disinflation effects of those kinds of restrictions could result in economic growth slowing, the ECB putting on more restrictions, or more aid rather, and that stimulus from the ECB then prompting this flight to havens, and really these bonds from governments in Europe really getting a bid, and that's exactly the kind of reaction we're getting today. Germany 10-year bond yields really close to hitting another all-time low at the moment, trading at the lowest since March. So you get a clear textbook risk-off day. You get the dollar moving higher as well. Francine, you mentioned earnings together. That's not helping a single industry group in the STOXX 600 move higher. I've got GRR on the screen. Even real estate, healthcare, some of these more safer names, utilities, they're not falling as much, but most of them are falling by more than 1%. Roche disappointing on their earnings, certainly not helping the healthcare sector here. You look at the bottom and you get those high beta names. You have auto parts, you have travel and leisure. Again, you have energy as well. We had Total disappointing on their margins. But when you have a day like this where the higher beta sectors are moving down, it's less about individual companies. It's more of the macro headlines that's guiding the markets towards a certain path. But usually in a day like this, unless it's really overwhelmingly good earnings, you can get some good earnings stories in there. But again, really high correlations between individual stocks today, seeing everything move deeper into the red as the trading day progresses, Francine.
Danny, thank you so much. Our Danny Berger there with the very latest on the markets. Now coming up, stimulus chances crumble. Steve Mnuchin blames politics for coming in the way of a deal. More on that next, and this is Bloomberg.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here in London as well is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Wells Fargo has fired more than 100 employees suspected of abusing coronavirus relief funds. According to an internal memo seen by Bloomberg, the bank identified staffers it thinks defrauded the U.S. Small Business Administration. The revelations follow J.P. Morgan finding out that dozens of its own staff tapped the rescue program inappropriately. The U.S. may be about to up its curbs on Chinese companies. Reuters is reporting the State Department wants to add Ant Group to its trade blacklist. The report says it isn't immediately clear when a decision will be made, but that it will likely happen before the fintech company does go public. And Ford will fail to meet European limits on greenhouse gas emissions this year. It's falling short because of a recall of plug-in hybrid SUVs after 7 caught fire while charging. Ford now has to team up with other unnamed automakers, pooling its fleet with theirs to meet the regulations. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, chances of Congress passing a stimulus package before the election are now all but gone. The Treasury Secretary, Steve Mnuchin, is blaming politics for undermining the month-long negotiations. The White House has criticized the Democrats for stemming the rescue plan, but Democrats have hit back, saying the administration didn't take the need for more stimulus to seriously enough. Now, joining us this morning is Maya Bandari, multi-asset portfolio manager at Columbia Threadneedle. Maya, as always, thank you so much for coming on. There's a lot going on. We're in the middle of earnings season, where we have a resurgence in COVID cases, and the stimulus in the U.S. that's not coming. What will drive markets in the next couple of weeks?
Good morning, Francine. Yes, you're quite right. I mean, there's certainly several risk events on the horizon. The second round of COVID-19 and the fresh slowing in activity that brings with it, as well as, of course, those downside risks from furlough programs at the end of this month in the UK, and of course we're now 2 months through the end of the furlough programs in the United States. And I think the balance is shifting in a slightly more cautious direction. From a risk perspective at Columbia Threadneedle, we're feeling a bit more neutral, certainly, than we were earlier this summer when we last spoke. Francine, markets have, as you know, come a long way from there, and the risks from all that we've just discussed are fairly significant. So, I think if we look at something like corporate bonds, for example, back in March, April, May, these were compensating investors for, 50 times the average historical default rate. Now they're actually trading slightly rich to those longer-term valuations. So, we continue to participate in select risk markets, but we are feeling more neutral on risk overall because we can't quite see that factor that will lift all boats from where we are right now.
Maya, how do you view the U.S. election? Is it a volatility risk? What exactly is priced in at the moment? Is it a blue sweep? And, how do you protect yourself against any eventuality?
Well, I think a blue sweep or a Democrat victory is certainly increasingly being priced in or expected, shall we say. We think it's likely to be associated with policy changes such as increases in corporate tax and capital gains taxes, and indeed a greater chance of regulatory reform that could, for example, limit tax ability to compound to infinity. But equally, a blue sweep on fiscal would be such that it would probably lead to higher nominal growth for the United States than the counterfactual, if you like. And so for us, this in turn removes a catalyst, if you like, for being negative on risk more generally, because I guess absent that Democratic sweep, you could have a self-imposed retrenchment of a fairly significant magnitude, a tightening of around 4% of GDP in the U.S. So I guess the upcoming elections haven't really altered our medium-term constructive view on the U.S., reflecting those two sets of factors where really we continue to hold exposure to the U.S. in a barbell with Asia as our favored way of taking equity risk. Those high-quality growth compounders are most found in the U.S. I should say, though, that the possibility, as you reflected, of heightened volatility in what could well be a contested electoral process is meaningful. This is reflected pretty well in option premia, where there's a fairly discernible kink around the period of the U.S. elections. And so that, if you like, is we think, pretty well reflected at the moment.
Maya, how do you view, the possible extra clampdowns or restrictions? It's unclear from, country to country, or even in some cases region to region, whether we'll have localized lockdowns or whether it'll be called something else. What does that mean for where you want to be invested in?
Well, I think those fears of second lockdowns, fears around future fiscal policy, and indeed that the end of those various furlough programs are all key factors that sort of tilt us at Columbia Threadneedle against broader cyclical or value-led exposures at the current juncture. Our macro views are fairly cautious. Now, I guess it's fair to say that, the widespread shutdowns that we had in response to COVID-19 delivered less of a knock to growth and indeed less of a knock to earnings than we feared. However, when we look at the more cyclical areas of the world, like the UK, like Europe, our forecasts are very close to the lowest decile for both growth and corporate earnings this year and next, reflecting very much those concerns. So we're very much, if you like, in a U or an L-shaped view of the world in current balance.
Maya, thank you so much. Maya Bandari there from Columbia Threadneedle stays with us. Now, coming up later this morning, we also speak to Howard Davies, the chair of NatWest Group. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's go straight to the markets because actually European markets are sliding. Now the focus, of course, is on the stimulus in the US. That's not coming. And the focus is also on corporate earnings. In many cases in Europe, they failed to reignite rallies. Now, overall, what I'm looking at is dollar also rising with treasuries. I would point out to the fact that Euro stocks 600 down 2%. US futures actually are dropping by less. The Chinese stock market continues to outperform peers in Asia. Now, European Union leaders are in Brussels today for a two-day summit. Boris Johnson has told the EU he's disappointed by the slow progress of Brexit trade talks. But negotiations will continue for now, postponing the decision on whether to walk away until tomorrow. Well, still with us is Maya Bandari from Columbia Threadneedle. Maya, I feel like it's deja vu. It's been years that we've been talking about, deadlines with Brexit. How difficult is it to know as a market participant what will actually happen, and so how you invest ahead of the decision?
You're quite right on the deja vu, Francine. On Brexit, I think it's quite remarkably unclear, if you like, where we ultimately land, although, of course, today's self-imposed deadline will not be held, which explains some of the optimism we're seeing being reflected in, for example, sterling and indeed gilts. Now, the odds of some agreement to our minds are greater than 50%, but not sufficiently so. And Columbia Threadneedle, we're cautious on both the UK economy and its assets, because, of course, not only are we facing the significant uncertainty related to Brexit, but there are at least two other factors to consider. The first being a fresh slowing in activity in response to fresh lockdowns to tackle those second waves of COVID-19. And second, fairly intense downside risks from the end of furlough programs at the end of this month in an essentially consumer-led economy. Now, these have, of course, so far made up for a sizable portion of the shortfall in pay, and measures that have been announced so far are not, to our minds, enough to make up the difference. So we expect a pretty sharp rise in UK unemployment once these furlough schemes fade. A similar risk, if you like, in this area to the US. And so from an asset allocation perspective, this sort of deteriorating story has led us to reduce our exposures to UK risk assets, like equities, which we downgraded in late July. I should say as well that, importantly, the composition of the UK equity market is also skewed towards those value factors that we discussed in your earlier segment, may be challenged in the environment that we envisage.
What do you do with pound right now, if anything?
Well, we're somewhat more cautious. Well, strategically, we're certainly cautious on the pound. And yeah, would very much maintain that view. I mean, I think we can sort of see how tactically you might have a little bit more strength coming through in sterling. But those factors that I mentioned, we don't really know where we're going to end up on Brexit after the end of this year. We don't know how the employment situation is going to play out, and we don't know how the economy is going to fare. Leaves us feeling relatively cautious. So we expect an 11% contraction in the UK economy this year, much greater than other parts of the world. Twice what we expect in the US, for example, and more than Europe and indeed Japan.
Maya, when you look at the recovery of the world, it's definitely uneven with, parts in Asia doing so much better than some of the Western economies. China also with some great export figures out earlier in the week. How do you play that?
Yeah, I mean, one area of surprising resilience has been Asia, both in terms of growth, but also in terms of earnings. And in fact, Asia is the only region outside the U.S. where earnings are actually expected to be above the end of last year's levels by the end of next year, except that you've got positive earnings being delivered this year and positive earnings being delivered next year. So from an asset allocation perspective, Asia and indeed the U.S. are our two favorite areas to take equity risk. And yeah, as you say, I think Asia has, on balance, had a pretty good crisis.
Thank you so much, Maya Bandari, there, multi-asset portfolio manager at Columbia Threadneedle. Now, coming up, not buying today, will activist shareholders say they want to block a €3.5 billion rights issue by shopping center operator Unibail-Rodamco Westfield. Our interview with the leading investor, Léon Bressler, is coming up shortly. We also look at the markets every 15 minutes. The focus is on the stimulus in the U.S., which does not seem to be coming. So if you look at stocks in Europe, I think they're probably declining on raising specters of extra restrictions or clampdowns, whatever you want to call them, for the economy. to deal with the rising cases of COVID-19. Also, corporate earnings failing to reignite rallies. And again, as I said, prospects wilted for this new stimulus in DC. Coming up next, we speak to Léon Brasler. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. France is imposing a curfew in Paris and other major cities. The measures will be in place between 9 a.m. and 6 a.m. for 4 weeks starting this Saturday. It is the latest move to contain the spread of coronavirus as rising infections begin to fill up hospital beds. Meanwhile, German Chancellor Angela Merkel is warning we can't afford a second wave of the pandemic if it is as strong as the first. Now, Singapore and Hong Kong are set to create a travel bubble. It will exempt people from both cities from quarantine. The move reopened links between Asia's two top financial hubs. Singapore says it hopes the bubble will start within the next few weeks. The news is helping air carriers in the region, including Cathay Pacific and Singapore Airlines. The chances of Congress passing a stimulus package before the U.S. election are now all but gone. Treasury Secretary Steven Mnuchin is blaming politics for undermining the months-long negotiations. The White House has criticized the Democrats for hindering the rescue plan, but Democrats have hit back, saying the administration did not take the need for more stimulus seriously. And tensions are rising between Armenia and Azerbaijan for the first time in 2 weeks of fighting over disputed territory. Azerbaijan says it's attacked military installations inside Armenia, which warns it may retaliate. The latest development threatens to bring Russia more closely into the conflict. It has a mutual defense pact with Armenia and says it's now studying that incident. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, a few sectors have struggled this year as much as the operators of shopping centers. A group of shareholders in Unibail-Rodamco Westfield are seeking to block the company's planned €3.5 billion rights issue. Now, in a statement today, the shareholders say they will vote against the proposed capital increase. They also argue that the Franco-Dutch company should instead sell its portfolio of U.S. shopping centers acquired during the Westfield takeover. Now, for more details on this, we're joined by Léon Bressler. He's managing partner of Ayremont Capital, former chairman of chief executive of Unibail, and of course he's one of these shareholders trying to change Unibail. Léon Bressler, thank you so much for joining us right here on Bloomberg TV. First of all, is it really the right strategy to, as you propose, to try and sell off some of the U.S. assets in a time where actually the market is so depressed that you wouldn't get much for them?
Good morning, Francine. Yes, it is the right strategy. You know, we are proposing an alternative strategy, but it's not an abrupt implementation that we're looking for. We do want to recreate a leading pure player in Europe, and we know that that's the right solution, that's the right recipe. It has worked before, it will work after. Investors want a pure play with the leading shopping malls in Europe, from Stockholm to Barcelona via London or Paris. And as far as the US is concerned, we're only a small player. In Europe, you know, Unibail is bigger than the number 2 and the number 3 combined. In the US, Simon Property Group, which is a great company with a superb management, is more than 5 times the size of the U.S. operations of Unibail-Rodamco Westfield. So we are leading in Europe, very marginal in the U.S., which is a very competitive market. So we have to refocus, and that's the name of our plan, refocus. We will not sell the U.S. Go ahead, please.
No, I was going to ask you, when would be the ideal time? So I'm also trying to understand from you, because you've been in the real estate business for a long time, when you think that it would be an ideal time to sell the U.S. You know, when are we going to see a pickup? When will things get a little bit more back to normal?
Correct. We'll take our time. You know, there's no specific pressure on the company. The company has ample liquidity, so that's not a liquidity issue. It's more a real strategic issue. And we'll do that over the next 2 to 3 years. If we can do it more rapidly, so be it. But you know, we don't want to rush into that. There will be a post-COVID world. The U.S. market will recover. The U.S. always rebounds more rapidly and more spectacularly than Europe. You have some great U.S. investors, and within the Unibail Westfield portfolio, which is too small to play a role, you have some superb assets. So really, we'll take our time and we'll do very well over the next 2 to 3 years, and perhaps more rapidly, and it will be a great result for the company.
You and your consortium have about 5% of Unibail, and Unibail doesn't have any major shareholders. So how will you get the others on board if you want to bring this forward?
Now, we only have 45%, but we have a leading industrial investor, shareholder in Unibail-Rodamco Westfield today. And we do believe that our plan is so strong that, you know, refocus instead of reset is so compelling that we should be able to convince all the major investors in that company to be with us. You know, clearly we will create value for them, while the rights issue would be devastating. You know, it would destroy massive value. The reset plan is to reset to zero, which is not what investors want. You know, what they want is value creation, They want a new strategic plan. They want a new entrepreneurial spirit. And that's a way to correct it. And I think that the market will react very positively to our approach.
Would you be willing to take a bigger share of this company?
Very much so. We are ready, but we don't intend to take control of the company.
But you're ready to up to how much?
We have no target there. You know, what is key is to make sure that we work as a team with all the leading investors. What is key is that the board supports a new strategy, which is a very compelling story, and that we relaunch a great company. You know, it's very bizarre that such a leading company, loses up to 85% of its value over 2-3 years. So it was a major strategic mistake. You know, the attraction of the U.S. Perhaps, has sometimes devastating effects on European companies, and Unibail-Rodamco would not be the first one to be the victim of that. So once we launch that new strategy, the value creation will be extremely rapid, and I'm sure that investors will come with us. We don't want to take control. We want to be a leading entrepreneurial shareholder in that company, but all the institutional shareholders will have their role, and I'm sure they will benefit very largely of that position.
Do you think that the current management of URW were somehow bullied into the rescue plan because of short sellers?
You have to ask the management. You know, what we can say is what we want to do, but it's clear that the management has been the prisoner of the Westfield disaster. You know, it's very difficult for a person to re-establish himself after such a disaster. So we know that it's very difficult for the present management to reimagine a new strategy. But, it will be up to the supervisory board of the company to make the right decisions. You know, we want to respect very strictly the best corporate governance guidelines.
How difficult is it going to be for shopping centers going forward? I know, are you worried that there was a cautionary tale into the shopping malls of, for mall landlords that actually didn't do rescue rights issue when they had the chance in hoping to do better by selling things off?
The Unibail-Rodamco Westfield is a completely different story. It's a major company. It's completely dominant in Europe, as I mentioned before, really from Scandinavia to Spain via Poland and Austria and France, and also 2 superb shopping malls in the UK. So if we talk about the UK, and Into was a pure UK company with some Spanish exposure, Westfield London and Stratford are clearly the best 2 shopping malls in the UK. Yes, they do suffer today, but they will recover because of their dominance. And it's the same for all the major malls of Unibail in each and every major city of Europe. I would add also that continental Europe, and all the figures demonstrate that, continental Europe has been a much better market for shopping malls than the US or the UK for a number of reasons, urban reasons, historic reasons, clearly regulatory and legal reasons, political reasons. So we have a much stronger position in Europe. Let me give you one example. For example, department stores in the UK still play a major role, and as you know, they are in great distress. Department stores have negligible space in continental European shopping malls. So that's one of the elements. I could add many others. For example, food, the distribution of food. The big food retailers are not key anchors in UK shopping malls, and they are key anchors in continental European shopping malls. If you go to a shopping mall in Spain or in France, you will see Alcampo or Carrefour or Auchan. So the traffic is much stronger, and there's no dependence on department stores, which are disappearing.
Léon Bressler, thank you so much for joining us today, and I hope this is the first of many interviews to look at this industry. He is the managing partner of Hermon Capital. Bloomberg has also reached out to Unibail for comment, so we're waiting to hear back, but actually the Unibail share price is gaining some 11% as we speak. Coming up another day, another deadline for Brexit as EU leaders gather in Brussels. No UK trade deal has yet been reached. We'll be speaking about the prospects for an agreement with the former UK Business Secretary, Vince Cable. That's coming up next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now, EU leaders head to Brussels today. It was supposed to be the summit where a Brexit deal was discussed, but not for the time, another deadline has slipped by. Now, if Boris Johnson told EU leaders he's disappointed by the slow progress of negotiations, but will continue trade talks for now. Both sides need time to ratify any deal by December 31st, meaning it would likely need to be in place by early November. Meanwhile, the German Finance Minister Olaf Scholz hinted that he expects a deal even if it comes down to the wire.
It is always the right way to discuss questions that are difficult up to the last moment. And my experience is sometimes in the last moment you will find a solution.
We're also getting a headline that will certainly impact pound and will certainly impact, of course, the UK economy, which is London could move into a tier 2 from midnight on Friday. That's according to ITV. Now, remember, it was just a couple of days ago that the Prime Minister Boris Johnson gave us an indication of these bands. There are 3 bands, so tier 2 would be right in the middle. And actually, I'm just refreshing my memory. It basically means that we wouldn't be in lockdown, and this would only be for London and I guess Greater London. But for example, nightclubs and other things would be closed. So again, it's just trying to contain the virus, not full lockdown, but something in between. According to ITV, we're also expecting the Prime Minister to make an announcement on London this morning. So let's get straight now to Vince Cable, the former leader of the Liberal Democrats. He's now a professor in practice at the Institute of Global Affairs at the London School of Economics. Vince Cable, I have many questions on Brexit, but let me just kick off, on these lockdowns and these tiers. You've been in government. How difficult is it to actually, go on with negotiations on Brexit, whilst at the same time trying to figure out how these lockdowns work and don't work, and briefing the nations?
Well, it's a terrible mess. I mean, I think part of the underlying problem is that the government is trying to direct the Brexit strategy entirely from Whitehall. It's a very centralized operation, and the system isn't able to deal with it. We don't have a track and trace system. That's the underlying problem. So, you know, very crude lockdown measures have been introduced, which are causing a great deal of economic damage. And that's superimposed on the Brexit shock, which is just around the corner.
How do you think Brexit will get resolved? At the moment, you know, we're waiting in the next 24 hours to know whether we have a deal. Is there, you think, from Downing Street, a wanting of a deal, or would they be quite happy to go to WTO agreements?
Well, there are people in government who clearly want the extreme option, the kind of rather ideological wing of the Brexit movement. I think in practice, the Prime Minister, the Chancellor and others are more pragmatic. They do want a settlement. And I think we will finish up with what I would call a minimal agreement. In other words, no tariffs and no quotas, but in other words, but all the other aspects of European integration we walk away from. I think what people haven't really focused on is the extent to which, even if we get a deal, the process of leaving at the end of the year is going to be very disruptive, because we are leaving the customs union. That is going to have significant effects on industries in supply chains. It's going to cause a great deal of additional bureaucracy and form filling, and all the feedback we're getting from the various transport groups and others is that British business is not ready for it. They're not ready for a new process of form filling, checking. They haven't done the background work, possibly because they've been distracted by COVID. And we are going to get quite a serious hiatus at the end of the year, whether there's a deal or not.
What are the chances of a deal, Vince Cable? How difficult, you know, the two sides are far apart, but Boris Johnson himself is actually leading almost the negotiations, almost directly with the President of the Commission.
Well, as I said, I think his instincts, and certainly the Treasury's instincts and the Foreign Office, some of the key people here, is to get an agreement. The agreement they're looking for isn't very ambitious. We know that there are two fundamental stumbling blocks. One is fisheries, which is a very minor issue from an economic point of view, but is totemic, and the British are looking for some concessions here, and they'll probably get them. The much more serious issue is the so-called level playing fields. I think some of us are baffled by this, because the British in the past have always been the country that wanted to have strict state aid discipline in order to prevent subsidization, which they expected would come from France mainly. What the British seem to be angling for is an arrangement where they can put money into very high-tech new industries. But that's never been a problem in the past. I was Secretary of State for 5 years, responsible for business, and we never had any serious problem with state aids.
Big metropolises like London are going through a tough time because of COVID-19. Vince Cable, the BBC just seconds ago, again saying what we had heard in part from ITV, saying London will enter a high virus restrictions, curbing socializing. Just a reminder for all of our London viewers, but also abroad, what the Prime Minister did earlier in the week is basically have a three-part tiering system. So you can say tier 1, tier 2, tier 3. This would be moving London from tier 1 to tier 2, which basically means that you can still socialize outside if it's not more than 6 people, but households cannot mix indoors. Vince Cable, if we have a no-deal Brexit and some of these lockdowns on the capital, London, what will London look like in 12 months from now?
Well, it's all very complicated. I mean, the Prime Minister himself has difficulties explaining what the differences are in behavioural change that we expect. I think most of us are totally confused. I mean, I think the substantive difference is in London is that there will be this ban on mixing between households. I suspect a lot of people become alarmed by the pandemic, are doing this anyway. I mean, I think part of the problem in the UK is total confusion lack of clarity in messaging, that's much more damaging to the impacts on the economy than the rules themselves. And we are operating in a very depressed economy. I think the latest projections are 9% decline year on year, the worst of the main industrial countries except for Spain, twice as bad as Germany or the United States. And I'm afraid Brexit coming on top of that is going to mean that the first quarter of next year is going to be really bad as well.
Given what some people call the chaotic handling of COVID-19, what do you see as Boris Johnson's political future? What will it look like?
Well, he's clearly very uncomfortable. I mean, this is not what he envisaged his premiership was going to be all about. He doesn't have the qualities to manage a prolonged crisis. He just wants to be optimistic, and there's a lot of wishful thinking going on. So we're not getting leadership here. I'm not a conservative, so I don't know what's happening inside the Conservative Party, but there are plenty of noises that they're pretty unhappy with his performance. I find it difficult to believe that they will jettison him so quickly. But there are people like the Chancellor who are outperforming him considerably. So we may get, if things deteriorate as they are, we may get some dramatic political move in the next few months.
Thank you so much for your time today. Vince Cable, their former Liberal Democrat leader. Now, coming up later this morning, we also speak with Sir Howard Davies, the chairman of NatWest Group. We'll talk about lockdowns. We'll, of course, talk about UK banks and lending. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the headlines on London are actually coming in thick and fast. Mainly they're from the BBC, but also the ITV saying we could hear from the Prime Minister shortly talking about a lockdown. Now, I don't know if we call it lockdown or extra restrictions, but the government laid out clearly, and yet there are so many questions, these three levels, these three tiers. We're currently at level 1, and actually we could go to level 2. This is what that would mean is basically no household mixing indoors. For the moment, 6 people can still meet indoors, so we'll have a lot more, of course, on that throughout the day. I don't know whether it's having an impact. I don't know whether it's having an impact on the markets, and I'm also being told that it's just being confirmed. So London is moving up to tier 2 from tier 1 from Saturday. I think it's probably the early time on Saturday, but it does mean that from Saturday onwards, households cannot mix unless outdoors and unless it's less than 6 people. Bloomberg Surveillance continues in the next hour. Tom Keane, no doubt many questions on lockdown in London. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
The second wave strikes Europe after curfew in Paris. London getting tighter virus measures. They'll be in place by Saturday morning. In Germany, new cases rise by a record amount. No deal. Steve Mnuchin downplays chances of fresh stimulus ahead of the election. Nancy Pelosi says White House offer remains significantly short. There are 19 days until the U.S. elections. And Brexit roundabout. Boris Johnson seems willing to overlook his self-imposed Brexit deadline. Germany's finance minister tells Bloomberg a breakthrough could happen at the last moment. Well, good morning, everyone, and welcome to Bloomberg Surveillance. Tom and Francine from London and New York. Tom, in the last couple of minutes, we had confirmation that actually there will be much more stricter measures on London from Saturday. Now, remember the three tiering system that we were talking about? Yeah. Alert 1, 2, and 3. Currently, we're at Alert 1, which means that it's only 6 people meeting at the same time, indoor and outdoors. From Saturday, that's all over. So restaurants remain open. Schools remain open, but 2 households or 2 bubbles cannot mix unless at work.
I'm speechless. You know, I was just talking to John Farrell. He was getting up, Francine, at the crack of 9 a.m. In London about the uniqueness of it. And, you know, right now there's 2 separate parallel worlds of the United States where really Europe and the pandemic is off the radar. And that very clearly in Europe, it is really unraveling, isn't it?
Yeah, it really is. And what's amazing is that, you know, we're all dealing with the same virus, having the same effect on people. But if you look at Germany, it's very different on how they decide to deal with it, you know, compared to Macron, who's also imposing some tighter measures. So we'll have a robust discussion on that throughout the day. Now let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom, the chances of Congress passing a pre-election stimulus are all but gone. Treasury Secretary Steven Mnuchin is blaming politics. Mnuchin says Democrats don't want to give President Trump something to brag about in his campaign. Democrats say the White House never took the need for another stimulus seriously enough to push for a compromise. And Senate Democrats are all but powerless to keep Amy Coney Barrett off the Supreme Court. So they used their final day of questioning at the confirmation hearing to grill her about statements made by President Trump. Barrett declined to answer whether the president has the right to delay the election and an absolute right to pardon himself. London reportedly will be placed on what are called high coronavirus restrictions. One of the curbs is said to be a ban on 2 separate households meeting indoors. The number of coronavirus cases has been rising. London will soon hit an average of 100 cases per 100,000 people. And British Prime Minister Boris Johnson told EU leaders he is disappointed by the slow progress of Brexit trade talks. Johnson says he'll decide after an EU summit this week whether it's worth continuing to work for a deal. Previously, Johnson had threatened to walk out today if there was no clear agreement in sight. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Hey, Ritika, thanks so much. Equities, bonds, currencies, commodities, a really oddity to the tape, and some of it, I would suggest, adjusted by the pandemic news out of Europe and now out of the United Kingdom. Futures negative 40. Everything pulls back here on a percentage basis. Dollar with some strength. I would note Swiss franc. Euro Swissy comes in strong, Swiss franc, 4 days in a row. Nothing to write home about, but we're watching that trend, as I would put it. Also on Euro Yen, we're looking at stronger yen and a weaker euro. Kit Jukes, I know, Francine at SocGen writing up on the ramifications of a 116 handle on yen, on euro rather, and we're not there right now. Francine, one quick note. The headline note, the real yield in the United States goes back to a full negative 1.00%. That will be noted today.
Yeah, Tom, you know what? I actually wanted to show you some of the bond yields on some of the European bonds because they're really, quite low. We haven't really seen anything like it, and that's on the back of the, ECB. But actually, I'm just distracted by what's happening in London, and that's impacting, for example, European stocks in general, as we're just seeing extra measures, measure after measure, clamping down to try and stop COVID-19 to take hold again, like we saw back in March. Londoners being banned from mixing with other households indoors from this weekend. That's impacting some of the markets, but what the market is also looking at, Tom, is certainly the fact that corporate earnings failed to reignite rallies, but also the prospect wilted for this new stimulus from DC. So actually quite a lot going on for a Thursday. We're delighted and really couldn't have been a better day to speak to Sir Howard Davies. He's the NatWest Group chairman, but he always brings wisdom to try and understand the world we live in. Sir Howard, thank you for joining us. We want to talk to you about Brexit, but before we get to that, in the last 10 minutes, we found out that London will go into this Tier 2 phase on Saturday. Is there a worry that between Brexit and London, being a big city affected by COVID, that we will lose London in 12, 13 months from now?
Well, I'm not quite sure how to interpret your statement that there couldn't have been a better day to have me. Is that because you associate me with bad news in some in some way. But anyway, I'll try and ignore that. I mean, let me say that on the lockdown measures, it is quite difficult to keep up, and there do seem to be a lot of different and rather confusing changes in the regime. So we'll all have to reflect on how that is. But on the upside, on the optimistic side, what I observe is that people are now finding ways of carrying on their business in the midst of all of these restrictions, and not ignoring the restrictions, but nonetheless finding ways of working around them. So I don't think that a second lockdown is going to be anything like the one at the end of March and in April, where basically the economy simply froze. I think we're now finding that people have found ways of working. People are much better at working at home. A lot more can get done. We observe that within the bank. So whilst it's bad news, clearly, that we are moving into a more difficult environment as far as managing the virus is concerned, I personally don't think that these further lockdown measures will have as damaging economic consequences as the first wave did.
But, Sir Howard, maybe that's what, for 70% of the economy? What about the other, 20, 30%, which makes it much more difficult? I'm thinking of either the arts or, the travel and leisure. And what does that mean for bank lending? Do you worry that there are going to be defaults in that?
Well, we certainly feel for those people, and there are clearly businesses, the famous city sandwich bars, but also the airlines and travel industry generally, who are going to suffer, and one just feels for them because they have been desperately planning in imaginative ways to reopen, and that looks as though that's going to be put on hold. So yeah, there is a chunk of the economy that will not work. As for bad debts, most banks, and we're no exception, provided at the first half for a large proportion of bad debts. I mean, the accounting rules require you to provide in advance. And I think all banks would say that the actual lived experience is not as bad as the provisioning, that the actual bankruptcies there have been some, but they haven't been a great wave of them. And that's probably largely because the economy is, as somebody said to me the other day, anesthetized, in that the provision of liquidity by the central banks on the one hand and provision by the government of financial support is preventing the disasters occurring, if you like, that at the moment the economy is just on life support, if you like. So, and I think that probably governments will just have to continue with that. Now, that's dangerous from a fiscal point of view, but clearly, if the governments are going to lock down again, then they will have to put in place extensions of the various measures they've had in order to support the economy. So at the moment, I think most banks, and I've been talking to a lot recently, because it's the IMF week, as you will know, where we normally would be on a speed dating course in Washington, but we've been talking to each other a lot anyway over the last few days. And I think everybody is in a similar position, well provided in terms of potential losses, not seeing those losses coming through yet, still worried about next year, but not over anxious about the position of the financial sector.
Sir Howard, Tom Keene in New York, good morning to you, and thank you so much for this generous time this morning. You know, we all read, I don't know, at Manchester Grammar School, if you were forced at gunpoint to read The Plague by Albert Camus, but there's a number of points in that wonderful book, that stark book, where things unravel. And there's that feeling this morning of the silliness of instituting a lockdown out on Saturday versus this Thursday. Do we completely misjudge the need for fiscal stimulus now just to actually jettison austerity to get to a vaccine?
Well, it is disappointing that the US stimulus will be delayed, and I think many in the markets have been hoping that there would be an agreement before the election, but that doesn't seem to be the case. But after all, the election is not far off. I do think that we're in a position where governments are going to have to continue with their fiscal stimulus. That is going to be difficult for some countries because, you know, the Germans had put in place a 1.3 trillion euro package. They've only spent about 100 billion of it, actually. So the Germans have got plenty of room to continue to support their economy. The UK is not in such a good position, but I think probably, given that we went into this with not a huge debt to GDP ratio, we can probably continue with what we're doing on perhaps a slightly lower scale. Other countries in Europe may be under more pressure. So I think my worry now is not so much a sort of aggregate worry or a worry particularly about the UK and Germany. It's that we will now identify weak spots in the European economy, which will require help from the centre. Now, the big bazooka of the 750 billion euro community-wide package is there, and I think that's going to have to be used. So if I were in Brussels today, I would be making sure that that is going to be mobilised as quickly as possible to help the people who are in trouble. That won't be Germany, but it might be some other southern European countries.
Sir Howard Davis with us here. Many themes to talk about in this half hour. And of course, for all of you in the United Kingdom and across Europe, extraordinary pandemic announcements today. The mayor of London, the third mayor of London, Sadiq Khan, speaking right now. We'll bring you those headlines as they evolve. Coming up later, what a wonderful day. Howard Davies with us, and then Ann Richards will join us from Fidelity International, their chief executive officer, yes, on asset management, but also Ann Richards on some of the unique mathematics of the investment business. We'll do that in the 6 o'clock hour. Futures in negative 37. Please stay with us. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
There are a number of weeks left in this negotiation, not a number of days. And so when the European Council meets at the end of this week, there will be a detailed stock take on where we are in these negotiations. But certainly I don't see that there will be any major breakthrough this week. I think there's been some progress on the level playing field issues. There's been little or no progress, unfortunately, on fishing, and both sides are still very far apart. The message was very clear, though, from member states today. We value fishermen. We value their contribution across the European Union. And certainly, EU fishermen are not going to be sold out in an effort to get an agreement on a future relationship with the UK on trade.
It is always the right way to discuss questions that are difficult up to the last moment. And my experience is sometimes in the last moment you will find a solution.
The Irish Foreign Minister Simon Coveney and the German Finance Minister Olaf Scholz discussing the prospects of a Brexit breakthrough. Now, we also want to bring you up to date with all of the headlines from the London Mayor, Sadiq Khan, who's commenting in an assembly meeting. This one is especially important after we heard that London will go into a Tier 2 alert level, meaning that from Saturday, as far as we understand it, households cannot mix. You can still meet people outside, but no more than 6 people at a time, including yourself, so it's 6 people in total. And of course, there will be a number of more provisions. I'm just trying to follow all of the headlines from Mayor Khan of London. He has called for a national virus circuit breaker. This has been called by a number of people, including the leader of the opposition, meaning that everything would be in lockdown for 2 weeks and no traveling, just to make sure that the number of infected cases does not rise. He's also asking London Mayor Sadiq Khan, the ministers, for more financial support. Now, let's get back to talk not only about these extra restrictions on London, but also Brexit. We're back with Howard Davies of NatWest Group. Sir Howard, thank you for staying with us. When you look at, Brexit, we're again in the next 24 hours on tenterhooks to find out whether there is a deal or there's no deal. Are all banks prepared? And do you think a lot of banks have actually left because they worry about passporting and equivalency, and they just can't afford to find out at the last minute?
Yeah, I think banks are as prepared as they can be. What is very disappointing to us is that when you hear the noises coming out of the negotiations, they mainly have a sort of fishy smell to them, or indeed they're about state aid, which is not particularly relevant to us. And what you don't hear much about is the important question of financial sector equivalence. And that would be a very important outcome if we can secure it. And we're hearing nothing about that. So we just don't know whether that will happen or not. As a result, banks have had to prepare for the prospect of no equivalence in the European financial markets. And so we have a subsidiary in the Netherlands through which we can do our business. It's not as convenient as doing it through London, but we are ready for that. So many people have prepared for it. They are suboptimal solutions. And over time, they will produce a drift of business into other European centres from London if we haven't got equivalence in these on the big directives, the Market in Financial Instruments Directive, etc. And so it's very disappointing to us that we are hearing nothing, and it doesn't seem as though much negotiating effort is being put into that question, which, with nothing against fishermen, and I eat a lot of fish, but nonetheless, the financial sector is a larger share of the economy than is the fishing sector, and yet we hear nothing.
I look, Sir Howard, at where we are in banking and the bank earnings stream of the United States of America, and there's a wide presumption that the U.S. banks can compete and take market share, take business in continental Europe as well. Can the United Kingdom banks do the same thing? Are you guys in a position to be like the American banks and really compete for business on the continent?
There are 2 or 3 things relevant here. One is, as in many things, the UK is sort of halfway across the Atlantic. And so exactly. If you look at our banks, we're pretty well capitalized, better than some banks in Europe. But there are several differences going on at the moment. One is that, of course, there is a dividend ban in the UK and in Europe, and there isn't in the US. The US banks have continued to pay out ordinary dividends, and that certainly helped their position in the markets. The second thing is that we in the UK have a handicap as a result of the ring fencing legislation, which requires us to separate our investment banking operations from our retail and commercial banking operations, and imposes a cost of capital penalty on those investment banking operations. And that has had an impact on the market share of UK banks in investment banking markets. And so what you have seen is that US banks have been relentlessly increasing their share of the investment banking wallet in Europe at the expense of some continental European banks who've been perhaps short of capital to deploy in that area, and at the expense of UK banks who have had the ring fencing penalty. And I think those have been the big drivers of the changes in market share.
Howard Davis with us here, stepping delicately through the bank discussion. He is, of course, NetWest Group chairman. We're going to continue here with Sir Howard for a brief amount of time. Really, truly breaking news across the United Kingdom, and quite frankly, waiting for comments as well this morning from other European leaders on a pandemic, a new effect, a new impact on Europe. On Bloomberg Surveillance today, Vitor Gaspar of the International Monetary Fund, very importantly, their Director of Fiscal Affairs, on the austerity and the reality of need for stimulus worldwide. Futures at -38. Stay with us from New York and from London. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Rishika Gupta with the Bloomberg Business Bash. Wells Fargo has fired more than 100 workers suspected of improperly collecting coronavirus relief funds. According to an internal memo, the bank determined that the workers defrauded the Small Business Administration. The memo said what happened were personal actions and don't involve the bank's customers. United Airlines says that it's ready to jump on any travel rebound while it's riding out the unprecedented industry slump. United's third quarter loss was worse than expected, but the airline lowered its daily cash burn rate from $40 million to $25 million. Plus, it had more than $19 billion in liquidity at the end of September. And Goldman Sachs warns that a number of policy and economic shifts will temporarily put an end to the outperformance of technology stocks. In a new note, Goldman says that laggards such as banking and auto shares will be lifted and upgraded its recommendation on those stocks to overweight. Strategists cut tech stocks to neutral. And that is the latest Bloomberg Business Flash. Tom, Francine.
Ritika, thanks so much. There is nothing more than a risk-off give back today. There's no other way to put it. With stronger Swiss franc, all sorts of safe havens, not through to stress, but nevertheless giving it back. The real yield, negative 1.0013 on that inflation barometer, claims at 8:30 this morning. Francine, futures deteriorate over the last 20 minutes. Negative 40 right now on the Standard & Poor's futures.
Yeah, if you look at European stocks, actually, they're down by more than U.S. futures are. We had some pretty disappointing earnings news. We've also had some clampdowns of some of the largest cities in Europe. And then at the same time, we were hoping for some stimulus in the U.S., and actually that is wilting. That prospect is wilting pretty quickly. So we're seeing quite a lot of pressure on European stocks. Coming up on Bloomberg Markets The Close, Joyce Chang, J.P. Morgan Securities Global Research Chair. Don't miss that interview. That's at 4:30 p.m. in New York. This is Bloomberg.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo. Creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning. morning, everyone. Bloomberg Surveillance. Francine Lacroix in a most interesting London right now. We've been monitoring headlines from the mayor of London and indeed from many in government today on the pandemic. With us for this hour, Howard Davies of NatWest Group. We're thrilled that he could join us today. Sir Howard, I just looked at the five-year break-evens, and the transatlantic tension on inflation is one, I'm thinking Irving Fisher, is one indicator of a society and of an economy is stark. Just in the last number of days, a reaffirmation of disinflation in Germany. I noticed the Swiss franc 20-year, rather the Swiss bond 20-year, down to new lower yields today. It is the oddest time. Tell us what the gap of a transatlantic spread in inflation expectations means.
Well, conventionally, one would say that it was likely to weaken the euro because people are looking at the prospect of zero or negative interest rates in Europe as far as the eye can see. So in the normal way, that you would think that would weaken the euro. But of course, there are other things going on in relation to the dollar and the US economy broadly, which appear to be offsetting that. But I mean, I guess the school answer to your question is that we should be looking at a weaker euro.
I mean, we should be looking at a weaker euro, and I can understand that's under conventional times, but this is not conventional times. How does your bank expect this to unfold? I mean, is it lower for longer, where you're strategically planning for a pronounced disinflation, or can you be more optimistic than that, say, on a 3-year plan?
We are expecting lower for longer. I mean, some people in the bank say lower forever, but I'm not quite sure. Forever is quite a long time. So lower for longer, yes, is a planning assumption. There are in the UK, which is our principal focus, of course, potentially some offsets here because the sterling has been quite weak and could possibly weaken further. In which case, given our very open economy, we have a tendency to import inflation through a weaker exchange rate. So that's possible, small offset. But I guess we are really assuming interest rates are pretty well zero for any reasonable planning horizon. It could be worse than that, in that, of course, the Bank of England have been asking us already this week to think about how we would cope with negative interest rates. I hope we don't go there, but that's clearly a possible outcome. So, yeah, I guess most banks would be looking at effectively zero interest rates for the foreseeable future.
Are you worried, Sir Howard, about the resilience of UK banks or European banks at all to COVID?
I'm not worried about the resilience of UK banks. We have very high core tier 1 capital ratios. Our last reported number was well over 16%, which is really high. And I think most of the UK banks are perhaps not quite as high. There are some odd features as to why we were particularly high, because we were expecting to buy back some shares from the government. So we had some money kind of salted away for that. So we were artificially highly capitalized going into the crisis, which has turned out to be quite a good thing, but I can't claim credit for doing that in anticipation of a crisis. But I think all of the big UK banks are in a solid position as far as I'm aware. We have some reporting season coming up, of course. In Europe, clearly the picture is more mixed, and there are moves to consolidate in order to cope with some of the weaker brethren, and you've already seen some of that in Spain and in Italy, and I think that's likely to continue. So it's very difficult to give a single answer in relation to the whole Eurozone, where there are some very strongly capitalized banks, and there are also some weaker ones who do cause some concern to the ECB, and that's why the ECB is often talking about the need for further consolidation of the European banking sector.
If we do have a no-deal Brexit, what would the UK economy look like in 2-3 years? What kind of incentives or what kind of economy would you tell Number 10 that the UK would need to thrive?
Yeah, well, I think it's everybody's economic analysis is that a no-deal Brexit would be damaging to the economy. Of course, when you're looking at a 9.5% decline in GDP in this year, which is the IMF's forecast they came out with yesterday, so the UK being more affected than other European economies, then, maybe the Brexit effect is somewhat lost in there because people were talking about 1 or 2% on Brexit, that, for the first year and a little bit continuing. So it's very hard at the moment in the fog of the COVID crisis to identify particular Brexit effects. But we still also don't know whether we're going to have tariffs or not. I'm still very much hoping that we come out with a deal and that the Prime Minister is prepared to carry on negotiating after today, even though we haven't reached the deal by his deadline. So there's still, I'm afraid, great uncertainties. I don't hide the fact that I don't think this is a good thing economically. I think there will be a damaging effect on the UK economy, but the scale of that is still quite uncertain and depends on the outcome of these talks in the next, couple of weeks.
Sir Howard, a generous amount of time with you today. Thank you so much. The chairman of NatWest Group and, of course, affiliated for years with the London School of Economics and his Oxford. Much going on. I mean, right now, risk-off feeling negative 40 on S&P futures with all sorts of correlations towards risk-off. Oil 40.08 in the United States as well. With our first word news in New York City, here's Ritika Gupta.
Thanks, Tom. Don't count on another pandemic stimulus package before the election. House Speaker Nancy Pelosi told MSNBC the two sides are far apart on worker safety, school funding, and a strategic testing plan. Meanwhile, Treasury Secretary Steven Mnuchin says Democrats don't want to give President Trump something he can brag about in the last weeks of the campaign. And Democratic presidential candidate Joe Biden ranked in a record $383 million last month. That broke the mark the Biden campaign set the month before. The massive fundraising hauls have helped Biden and the Democrats reverse President Trump's one-time financial advantage. In France, President Emmanuel Macron has imposed a curfew in Paris and other major cities. That extraordinary step is part of a series of new measures aimed at containing the spread of the coronavirus. Rising infections in France have started to fill up hospital beds. Billionaire Robert Smith will pay about $140 million to end a 4-year U.S. tax investigation. Bloomberg's learned that Smith also will have to admit wrongdoing. The probe focused on assets held in offshore tax havens. Smith is CEO of private equity firm Vista Equity Partners. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
All right, Ritika, thanks so much. Risk off the United States 10-year yield 0.6991, under 0.70%. We've been really focused on the pandemic on the continent and the news out of the United Kingdom here in the last hour. A turn to American politics. Stephanie Kelly will join us with Aberdeen Standard Investments, their senior political economist. Futures over 1.2%, negative 41 on S&P futures. This is Bloomberg. Stay with us.
I got up about 5:15 this morning. Got me a cup of coffee. I came out here. The line was progressively getting longer.
As much as I hate to stand in it, I'd love to see everybody coming out, participating, and doing what they need to do, practicing their civic duty.
opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, you know, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
We are trying to help, and we're trying to get some stimulus money, which I think is very important for certain industries, certainly the airline business. You know, people aren't exactly hopping into airplanes to travel. And then you go to Europe and you have to quarantine for 2 weeks. Who's going to do that? Is there anybody in the world that's going to do that? So we're working with other countries.
I'd say at this point, getting something done before the election and executing on that would be difficult, just given where we are in the level of details. But we're going to try to continue to work through these issues.
The Secretary of Treasury, they were moving markets yesterday. There's no question. Mr. Mnuchin, maybe Trump and Biden didn't move the markets, but the Secretary of Treasury did yesterday afternoon. And Ebb, which continues now, new lows today, futures at negative 44, Dow futures at negative 315 as we speak. Stephanie Kelly with us right now with Aberdeen Standard, looking at the United States of America politics, which is a difficult look at right now. There are so many cross currents, Stephanie, and one of them that we're seeing is a more removed Vice President Biden with very measured speeches, it seems, and Mr. Trump really out there, but some would say with conflicting messages. What do you observe as the message that the president needs right now?
I think for the president, clearly the message that they want is anything that's not COVID, anything that they can do to get away from COVID and the economic damage it's had, the health damage it's had, is clearly what the campaign is shooting for. Now, you can see that that means that you end up with quite a lot of different messages coming through. I think the challenge is if you've got a ton of different messages and you're running a political campaign, the risk is none of them really kind of hit anyone in particular. I think on the other hand, the Biden campaign have played this quite safe, cautious campaign approach of just standing back and kind of allowing the Trump campaign to attempt to get through this period. And I think what you're seeing in the polls with a 10 percentage point lead for Biden is that it's not working for Trump and it is working for Biden so far.
You may be getting the beauty rest tonight, Stephanie. Francine Lacroix will be up at 1 a.m. London time watching each and every minute of this historic moment, the oddity of a non-debate on two separate channels. On ABC, Vice President Biden, on NBC, scheduled President Trump as well. What will you listen for out of this truly historic moment?
I think there's probably two things. The first is I actually thought in the last debate, Trump's kind of quite aggressive approach actually helped Biden at moments, because there were moments where it looked like Biden was about to really be in a corner trying to answer a question he didn't want to answer on, say, Supreme Court justices. And then Trump would kind of step in and start kind of speaking, and it would give him time to come up with something or to just direct back at Trump instead. So I'm interested tonight to see how Biden deals with kind of the airtime and how he fills that airtime in a way that reduces the risk. Because to me, it really comes down to, with 10 percentage points lead, this is Biden's race to lose. We know from 2016, crazy things can happen at the last minute, and anything where you've got a candidate who's been kind of hidden away to a degree, these moments are risk moments for him. For Trump, I don't think there's as much risk moment. I think it's more going to be around, does he try and settle on a specific idea, or does he continue to try and push these kind of campaign messages that haven't landed about, you know, Joe Biden being socialist? Those kind of things aren't landing, and it's interesting whether there might be any kind of shift tonight.
Stephanie, is this about, you know, solidifying your base? Is this basically each candidate just making sure that people turn out to vote no matter what?
Yeah, I mean, honestly, I'm always a little bit skeptical of the impact of debates one way or another, but it is very much, it's a mobilization campaign rather than necessarily kind of trying, at this point, trying to get to, you know, a new voter base or trying to really shift hearts and minds is going to be tough. A lot of it will be, we've already seen from the Biden campaign, pushing for people to vote in person if they can, but if not, vote by mail and vote early. We know that that's been taking place quite a lot already. And then for Trump as well, it's going to be around trying to energize that base. The extent to which you can do that, in this kind of context, for me, it's always like, what are the media snippets that get picked up and spread really widely the next day? Because chances are most people aren't watching the kind of quote unquote debate live, right? They pick up the main headlines, and that's what pervades, and that's what can have an impact.
Stephanie, I don't know whether to ask you whether we trust the polls, or are you worried about turnout, or, the market seemed to be pricing in a blue victory. How big could that blue sweep actually be?
So I think the polling question is a really interesting one. We get it quite a lot because there's a perception that in 2016 the polls were, totally wrong. I mean, the reality is at the national level, they actually weren't that far off, and we're kind of in a normal margin of error. I think investors aren't used to this idea that polls can be right even if they're 3 percentage points off of what they said. Now, at the state level, there were more issues with polling, and particularly they didn't capture that education level. And we know education is a crucial differentiator between Trump voters and non-Trump voters. And so we know pollsters have made lots of changes. The reality is, though, we don't know how much they've changed. Have they overfitted? Have they underfitted? Or will they get it just right? It's a little bit of a Goldilocks polling moment. And the reality is we won't know until the day of. However, with a 10 percentage point lead at the national, it's harder to buy the idea that maybe actually Biden's doing better than the polls show. Maybe he's doing a little worse. But again, with 10 percentage points, he has a lot of room for maneuver, even if the polls are wrong by 3-4 percentage points.
And it is certain after the theater tonight that the story will be different tomorrow. Stephanie Kelly, thank you so much, with Aberdeen Standard Investments here 19 days on to the election. The next real debate scheduled for October 22nd. With our business flash in New York City, here's Ritika Gupta.
Thanks, Tom. Taiwan Semiconductor Manufacturing has raised its full-year forecast again. The world's largest contract chip maker posted a larger-than-expected 36% increase in profit. TSMC was boosted by orders from Apple in advance of the new iPhones. Home sales in Greenwich, Connecticut had the strongest quarter in more than a decade. New Yorkers piled into the town, searching for extra space in the pandemic era. Sales of single-family houses in Greenwich rose 70% in the third quarter. The median price, a little more than $2.1 million. And there was an unexpected increase in third quarter expenses at Wells Fargo. The bank addressed old scandals and another $718 million restructuring. Meanwhile, profit plunged 56%. Here's Wells Fargo CFO John Shrewsbury.
Have been down below analyst expectations up and down the street. Our charge-offs were 29 basis points in the quarter, which mirrors the best of times. And so while we're not out of the woods because there's still uncertainty in terms of the path of where things could go, it does feel a lot better than it did a quarter ago.
And that is your latest Bloomberg Business Flash. Tom, Francine.
Ritika, thanks so much. Greatly appreciate that as well. There is an election, and tonight, historic moment. I believe the president in Miami or from Miami with NBC, and of course, Vice President Biden with ABC. Coming up on Balance of Power, David Weston drives forward the conversation. Florida Representatives Neil Dunn and Debbie Wasserman Schultz. Look for that in the 12:30 hour this afternoon. Futures at -43 from New York and from London, considering a new form of the pandemic. This is Bloomberg. Good morning.
Welcome to That's Debatable, an interactive series on today's most pressing issues. The resolution this time, is it time to redistribute the wealth? Two perspectives.
Pointing to billionaires and saying we should take their money away is ineffective political strategy.
We have a choice in this country, either great wealth in the hands of a few or a democracy.
I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday at 7 p.m.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
If we need to act, it's in order to halt the spreading of the virus. Firstly, to protect others, sometimes ourselves, to protect the elderly, the most vulnerable, those in a precarious situation. That's the first objective. Secondly, we need to protect our healthcare system, our caregivers.
That was the French President Emmanuel Macron imposing a curfew in Paris and other 8 major cities. Now, countries across Europe are ramping up efforts to stem an unrelenting virus resurgence. Germany has also seen a record number of cases after Chancellor Angela Merkel warned that Germany's economy cannot handle a second wave. And then, of course, you all know, in the last 55 minutes, extra restrictions on London from Saturday early morning. Well, joining us now in Berlin is Chad Thomas, our Bloomberg West European managing editor. Chad, thank you so much for coming on. I mean, we're all dealing with the same problem. It's a virus, people get sick, some people end up in hospital. So why are the remedies from country to country actually so different?
Yeah, hi, Francine. I think the real answer here is that everyone is sort of taking a stab in the dark here, trying to come up with remedies that will try to bring the virus under control, but that avoids the lockdowns that we saw earlier this year. Of course, economies across the region and truly the world took a huge hit during those lockdowns. And so everyone is looking to say, what can we do to stem the virus in those hotspots that won't impact the economy? And that's why we're seeing such big different responses across the region. But clearly the one thing that we're going to see more of are these localized lockdowns, and primarily in the biggest cities around Europe.
Chad, in the United States, we have Dr. Fauci and the president battling on an hourly basis, it seems, in the heat of the election. On the continent, are the politicians listening to the scientists?
Tom, that is a really good question. And the fact of the matter is here is the response is very different in Europe than in the U.S. There is no discussion about whether to wear masks here. Every top politician is doing it, and they're telling people to wear a mask. There's no questions about social distancing. The real discussion, there are political disagreements here, of course, but the real discussion in Europe is about the measures that go beyond that. Do we close down restaurants, and for how long? And do we allow people to travel? And if they can travel, where to? But when it comes to the questions of the science, you have really all of the leaders following that. And of course, Merkel is herself a scientist, the leader here in Germany, and she has very much said that we have to follow what the scientists tell us.
Chad, we had a great conversation with Sir Howard Davies, the chairman of NatWest Group, and he was saying even if there's a second lockdown in the UK, and I'm assuming that would be similar for France and Germany, it would be a very different kind of lockdown or different restrictions because we've learned to live with it more than we knew how to handle it back in March. How do you see that?
I think that is very true. We know so much more about the virus now, and we're also honestly learning to live with the number of cases that we have. I mean, Germany today surpassed the daily number of cases, the record that they had set earlier in the year. And while there are new restrictions coming in Germany, no one is talking about a full and complete lockdown. One of the real big differences as well is that while hospitalizations and deaths are, sadly creeping up, it's nothing like we saw earlier in the year because we know more about the virus and we're doing a better job of dealing with it when people do get it. And it's generally younger people who are getting the virus now as opposed to an older population.
Chad Thomas, thank you so much. Greatly appreciate it today from Berlin. And don't forget Matthew Miller early in the London morning from Berlin each and every day. Futures -40, Dow futures -283. I really want to mention, Francine, a deterioration in the real yield yield in the United States, negative 1.00 now in the real yield. That's a big change over 4 days. Almost disinflationary tendencies rampant. Francine, can you imagine we may get a 116 handle on euro?
Yeah, I was looking actually at euro levels, and this is going to be something that we could hear a lot more about from the European Central Bank. But I also wanted to show you very quickly, Tom, some of the yields on European bonds. I mean, they're just absolutely extraordinary. I know it's partly ECB, but also it could be also something a little bit more drastic underneath that. We'll speak to Ann Richards next time.
Yeah, Ann Richards of Fidelity International. We can talk to her about those glide paths of disinflation in Europe. Please stay with us on the American elections. This is Bloomberg.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This morning, there is no debate. Well, actually, there is no debate tonight, but there is zero debate. There is, quote, an enormous wave of early voting. Nearly 1 in 5 in North Carolina, they did not vote in 2016. Markets, well, they drift. Let's call it risk off and lower. The real yield, once more, a negative 1.00%. John Farrell, apoplectic claims at 8:30. And talk about socially distant. Okay, here's how it's going to work. Dueling candidates, Biden on ABC, Trump on NBC. CBS will offer Big Brother. The House guests are sequestered. They have no TV. They will not be allowed to watch any Trump or Biden campaign ads. Punishment, I say. This is Bloomberg Surveillance. Good morning, everyone. Tom Keene in New York. And Francine Lacroix with news flow across Europe. Extraordinary. Francine, the good news is I can forget about Brexit. It's gone. It is adaptation at the federal level to the pandemic. It's so different than in America.
I'm sorry, Tom, you can't forget about Brexit. In the next 24 hours, we'll know whether we have a deal or no deal. So almost there. And certainly by next Monday, when London will have moved to Tier 2, which is the middle level, which is you can still meet people outside, but you can't let people come into your home. We should have a better idea of what London will become over the next couple of weeks. We saw a similar move also by the French President Emmanuel Macron late last night, actually announcing that 8 cities will go in lockdown, Tom, and that's hurting a lot of the stocks.
I mean, there's 8 ways to go here, Francine, and just because of compressed time, are the Chancellor of the Exchequer and the Prime Minister, are they on the same page?
They're on the same page, but we did hear from the London mayor, who, of course, is from the Labour Party, and just like the opposition leader, Keir Starmer, has asked for a national lockdown. So we call here, we call it the circuit breaker, Tom. So the idea is that for 2 weeks, we go back in lockdown so that the cases go down. This is not what the Prime Minister wants to do, but we also know that, for example, the London mayor will just ask for more money. I'm getting all choked up because, there's a lot going on. We'll ask for more money for Parliament to make sure that the people that can't go to work don't go hungry. Yeah, Francie's choked up, folks, because she bought the 50-year Italian bond like 10 weeks ago, and she's in like Flint here with a yield up. This is importantly, folks, we make a joke about it, but within these disinflationary tendencies, we are seeing bond prices elevate in Europe with yields down to unimaginable lows. Right now, what a Thursday. Our first word news in New York City. Here's Ritika Gupta.
Morning, Tom. Francine, the chances of Congress passing a pre-election stimulus are all but gone. Treasury Secretary Steven Mnuchin is blaming politics. Mnuchin says Democrats don't want to give President Trump something to brag about in his campaign. Democrats say the White House never took the need for another stimulus seriously enough to push for a compromise. Senate Democrats are all but powerless to keep Amy Coney Barrett off the Supreme Court. So they used their final day of questioning at the confirmation hearing to grill her about statements made by President Trump. And Barrett declined to answer whether the president has the right to delay the election and an absolute right to pardon himself. And new restrictions being imposed in London in an attempt to stop the rise of coronavirus cases. Londoners will be banned from mixing with other households indoors. The new rules start this weekend. London will soon hit an average of 100 coronavirus cases per 100,000 people. British Prime Minister Boris Johnson told EU leaders he is disappointed by the slow progress of Brexit trade talks. Johnson says he'll decide after an EU summit this week whether it's worth continuing to work for a deal. Previously, Johnson had threatened to walk out today if there was no clear agreement in sight. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine and Tom.
Ritika, thanks so much. I'm going to keep the data check short here to get to the landscape of American politics. Futures negative 35, negative 41 earlier, really risk off across the board. The VIX goes out almost 2 big figures, 28.23 on the VIX. If I had to single out anything, it is disinflationary indications within Europe. The Swiss 20-year, I don't have this up on the boards, 0.315 negative, not down to record lows or recent record lows, but it is a Swiss franc and yields in Europe that are shockingly lower. Francine.
Tom, so stocks are tumbling in Europe, but we had a bit of disappointing earnings news. We also had a bit of disappointment on the U.S. stimulus, which is playing out in Europe. And then, of course, these lockdowns by some of the region's largest cities to curb the virus also hurting investors' confidence. So you can see the Europe stock 600 down some 2%. And then I'm looking at pound because, we're on Brexit watch, as always, but especially today until tomorrow as EU leaders meet in Brussels.
19 days to go, Francine, towards this unique and historic election. Ryan Teague Beckwith watches it moment to moment. our political reporter. Ryan, I don't think enough has been made of truly the history made this evening. To explain this to our international audience, there are three major private networks, ABC, NBC, and CBS. And tonight, Ryan, we will have one candidate on NBC, one candidate on ABC at the same time. What do you expect to witness?
Well, it's going to be a little bit tricky for people like myself who need to watch both of them. So I guess I'll be doing a split screen. I think that you're going to see a lot of people just picking one and going with it. So they're really going to end up speaking mostly to their own base. I mean, if you like Biden, why would you watch Trump? If you like Trump, why would you watch Biden? So I think that's probably a metaphor for how politics is going in America right now. Everybody's just in their own bubble.
I've got 8 ways to go here, Ryan. I'm going to go to the money. It is extraordinary, over $700 million, I believe, that the vice president has raised in the last 60 days. I think I have that math right. President Trump, widely reported, is struggling to find how to allocate from one battleground state to the other TV ad spending. How important is this money divide?
This really gives Biden the advantage to press into territory that he might not have if he didn't have the money. He can run ads in places like Iowa and Ohio without really even committing to the states. I mean, normally they have to kind of make a decision at this point about, okay, do we think that it's still winnable in this state, or should we commit our resources to this other state that's a must-win? With the kind of money that Biden has right now, and more importantly, the advantage that he has over Trump in the cash on hand, he can go ahead and say, yeah, what the heck? It's like playing Risk or something, like late in the game and you're doing well and you just keep putting troops in other places.
Ryan, what can you tell us about what the strategy of each candidate is now? Is it, do they just need to, are we talking about undecided voters, or is it just making sure that people that will vote for you will actually show up and vote?
So they appear to be following different strategies on that. The Biden campaign very much is in playing it safe mode. They're trying to run out the clock without causing any controversy. I think you saw that with the packing the court, where he didn't want to say either way, really, because he just didn't want to say anything that made news. He even said this when asked about, like, well, what do you think about packing the court or expanding the size of the Supreme Court? Biden just said, I'm not going to answer that, because if I do, then you'll write a story about it. I mean, that's kind of a remarkable thing for somebody to say at this point in a presidential campaign. They're usually begging for you to write about them. Trump, on the other hand, it's hard to get a handle on his strategy. He's spending a lot of time talking to people on Fox News, and that may be because he likes doing that, obviously, or it may be that he thinks that this is a way to shore up his grassroots and his base. A lot of what Trump has done has really been aimed at the people who already support him and really trying to amp up turnout among them. He is doing some of the traditional things that you would see in trying to reach out to undecided voters, but I think you can see that his heart is more in reaching out to the grassroots.
Ryan Teague Beckwith, thank you for the update here on an historic day. The last 48 hours, folks, have been extraordinary. For those of you not watching this tick by tick, there's simply been a shift, as there always is, as you near an American election. The discourse has changed, to say the least. David Weston will tame the discourse this afternoon. This is in the 12:30 moment with two from Florida, Neil Dunn and Debbie Wasserman Schultz on Florida. The polling there is really, really interesting, to say the least. Mr. Weston with an update. Futures, -38. This is Bloomberg. Stay with us.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, let's get the view from the C-suite. The Institute of International Finance has gathered top executives this week to tackle the most critical issues facing the financial industry as a result of COVID-19. Anne Richards, Fidelity International Chief Executive, is among the speakers at the virtual event and joins us now. Tom, of course, and usually joins us from the IMF World Bank meetings. Anne Richards, thank you for joining us. I mean, there's so much going on that actually we weren't sure what to start with, in speaking to you. And I guess the worry is that there's going to be a shock out there, despite all the different angles and all of the uncertainty, because of U.S. elections, because of Brexit, because of COVID. What do you think the market is currently looking at?
It's so interesting because it feels like, in a way, that we had 6 months of the year in stasis almost, and then a bunch of stuff has been compressed into these last 2-3 months of the year. And when you look at how markets rallied so very strongly, fueled by all that wonderful monetary stimulus, which got everything going again, I think people really forgot about the risk of a second wave. And I think the belief and the hope was that the combination of the monetary stimulus that we had and then the fiscal spending which came on the back of it, that was going to be almost one and done, and we were going to be through this. And I think that is pretty much how markets were pricing. And the reality, and you can really see it coming through in markets today, for example, the reality is the markets were overpricing that. And now, as the risk of that second order effect from stimulus perhaps being stepped back from some of that support being taken away, you can start to see the effect coming through a market. So I think they were priced to perfection, and we're realizing the world is not a perfect place, and we've got we're in this for the long haul. So I think that's what you've got going on today. It's a reality check.
I mean, can we still rely on monetary policy to do more, Anne, if needed?
I think you can. I mean, I think the lesson of the last certainly the last 9 months has been, but actually you can go back quite a bit further than that, is that the capacity of central bank balance sheets to expand and to act as a kind of buffer, a kind of holding pen for effectively government debt issuance, that has gone much further and has had much more effect than any of us thought was possible. It's the old Bernanke quote where he said that it's QE and unconventional monetary policy, which has become very conventional, doesn't work in theory, but it seems to in practice. And I think you will see that support going through there. But I think the reliance on that of this stimulus continuing and of the lack of likelihood of a second wave, that's gone. So you're seeing that reality check. So I think monetary support will be there, but in and of itself, it's not quite sufficient. We need more on the back of it.
And I want a banker's fee when you sell out Fidelity International. Off the Eaton Vance transaction at Morgan Stanley, I price you out at $7.66184 billion. You don't have to go to 5 digits with me, Ann. What is the symbolism of the roll-up of the mutual fund business by these banks?
It's so interesting. I think what is going on here is the realization from many companies, Morgan Stanley is a great example of that, there has historically been an intermediary in the market, understanding that what they need to build out ultimately is the connectivity with the end customer. So you're moving into a more direct customer. So you put this together with the acquisition around around stock plan services. How do you connect in with the customer? I think that's what this is all about, and it's the beginning of this almost shortening of the chain, so that you can do more joined up delivery to the direct customer. And in order to do that, you need to be able to manufacture the investment offering, and that's what that's all about.
Well, I like the idea. We're having a little bit of audio trouble there. We will continue. Ann Richards, I look at the idea of manufacturing of product innovation. What do you manufacture here? Can you manufacture active management, or do you manufacture what I'll call enhanced index products?
Both, they're the same thing at the end of the day. I mean, when I started in the investing world, benchmarks were a thing you kind of stuck in there to show a client roughly how you were doing. And this idea we got into for a while that active management always had to be done relative to a benchmark. What you get with index customization and what you get with truly active management is something which is reflective of what the end customer, what the end client wants to do with their money. And so the active passive debate, in a way, becomes an academic debate. It's about where you allocate capital at its most fundamental. And you can do that through creating customized indices, or you can do that by having somebody sitting there fundamentally picking some shares or picking some bonds.
Ann Richards, well, let's continue. Ann Richards with us with Fidelity International, their Chief Executive Officer. This on a day of risk off, no question about that. Futures at -40, Dow futures -294, and all sorts of other correlative indications. I'd note Euro 117.08, 1.1708. It is a week of meetings, the Milken Institute, the World Bank, and of course the International Monetary Fund. On Bloomberg Surveillance this morning on the need for fiscal stimulus, Vito Gaspar of the IMF. This is Bloomberg. Good morning.
Gender-neutral language at the airport and on its flights. Instead of the greeting, ladies and gentlemen, the English announcements now use phrases like all passengers or good morning and good evening. There's no change to the Japanese version because we already use which is the honorific form of everybody, and that's already gender-neutral. JETA becomes the first Japanese airline to make the change as part of its greater initiative to tackle gender-based discrimination, following some other carriers. Air Canada and EasyJet started using gender-neutral greetings last year. Japan Airlines also ditched its mandatory high heels and skirts rule for female flight attendants earlier this year after the Coup2 movement went viral on social media. That was the nationwide campaign to fight the rule that some women must wear high heels at work. So JETA now allows female flight attendants to wear trousers and flats if they want. Activists here have been pushing for change, fighting against entrenched gender traditions. The Japanese government does not legally recognize same-sex partnerships, although a growing number of cities have started to. So this change towards gender-neutral language could be a symbolic step for inclusivity in Japan.
This is Bloomberg Surveillance. I'm Francine Lacqua in London. Tom Keene in New York. We were talking a bit about the industry, and we're back, Tom, with Anne Richards, Fidelity International Chief Executive Officer. And, if you look at your industry, it's under immense pressure just as a whole, just to find yield. Are we going to see too much risk-taking in certain parts of, of the financial markets?
Too much risk-taking, it's kind of an interesting concept. If you think about what we're trying to do, which is, for the most part, create the means by which people can save for retirement and old age. I mean, that's the big driver of much of what goes on in our industry, whether they're doing that directly or whether they're doing that through institutions or wholesale or wealth managers or whatever. There is a need to find the places, get the capital to the places which can generate return on that. When it comes to specific risk-taking, everybody's risk appetite is different. But what we have been seeing in the market is this kind of, whether you call it a two-tier economy or a two-tier market or a K-shaped recovery, there's lots of different ways of describing it. There has been more discrimination between sectors about who the winners and losers might be, and actually within sectors about how the winners and losers might be, who the winners and losers might be. And I think that takes you to the point of you have to understand what is the inherent risk within an industry and where is the ability of an individual company or an individual sector to respond to what's going on in an effective way. And that's partly about the government support it's getting, and it's partly about the effectiveness of its management. So I think when you look at that, our job in terms of discriminating between the companies that are likely to do badly is super important within that. And that means balancing has too much been priced in, because one of the biggest determinant of risks is actually, did you pay the right price for it or did you overpay? So I think in this environment, our assessment of what constitutes risk is very different from simply looking at volatility and looking at some of the short-term moves that you see, and is much more about thinking, what is the likelihood of a business actually to get through this? And that's one of those really big drivers, and it comes down to individual stock at the end of the day.
And Richards, we're just getting some breaking news out of Brussels. Mr. Mark Rutte saying that the UK movement is necessary for a Brexit breakthrough, because at the moment, of course, we're waiting to find out what happens with Brexit. What does it mean for asset managers? I know, a number, and we have Mr. Mark Rutte speaking live to reporters there, but a number of, participants in the financial industry have already taken steps to be sure that they can service their clients. What does it mean for, for asset managers?
Well, look, for asset managers, I mean, the one thing that we've had a sort of a good time on is the preparation time for figuring out where you need to get the licenses, the regulatory permissions, what you need to have where. We are a business which has just shown over the last 6-9 months or so that we can operate virtually very well. So our ability to move things around, there's been a lot of time and preparation gone into that. I think the thing that we are fearful of, though, is not our ability to continue to operate. I think as an industry, we have demonstrated we will be able to do that through Brexit. But I think that the risk is that we end up with a fragmentation of the UK, which is the biggest financial centre in Europe, which has been doing incredibly well, even despite all the kind of threat of Brexit that's been overhanging our heads. We've got very well managed and very well integrated supply chains right through the capital market structures that underpin asset managers. And I think the risk is that we are going into a more fragmented world, which means it's harder for capital to move around. Asset managers might have to separate legal entities, they might have to physically separate teams, they might have to physically separate the administration. And all of that, when you put that together, means a less efficient industry. And that means actually ultimately more cost, more friction in the flow of capital around. And that's not what we need right now.
Anne Richards, thank you so much for joining us. She is with Fidelity International, their Chief Executive Officer. I believe she's going to stay here. Excuse me as well. Francine, Mr. Rutte there, trending a fine line. He is part of a continental Europe group really in search of an older way. I mean, there's no other way to put it, right?
Yeah, he was part of the Frugal Four, Tom, so he's put extra pressure, certainly when it came to the EU Recovery Fund. But here he plays a little bit of a different role when talking about Brexit, because he's much more in consensus with Germany and the others about how you deal with the UK. And he's saying now that a breakthrough in these talks is still possible. But remember, we should find out more in the next 24 hours. So once again, it's another, Brexit deadline, Tom, that you and I are looking at.
Very good. Ann Richards to continue with us here with Fidelity International. On Bloomberg Markets today, Joyce Chang of JP Morgan. Futures negative 41. This is Bloomberg. Stay with us.
The Census Bureau has asked Congress for a 120 extension. I don't know that you even have to ask, and I think 120 days isn't nearly enough.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
There has been big restrictions this week across Europe, including your country. Does that worry you when it comes to the European recovery? Because, markets, economies were optimistic before the summer, but it's clear now the tone has really changed.
I think the best guarantee for recovery in Europe is that we take the necessary measures when the virus is again spreading at a speed which is too high. If it would then be too lenient or would not be able to reach decisions to contain the virus, that would be of a huge disadvantage to the economy. So yes, rather you have the virus, and of course, at a low spreading range, but when it is again taking up and it is spreading again, then you need to take the necessary measures, and that in the end is what you need to do for the economy too, because that provides clarity, a government which is absolutely committed to beat the virus. That is what business people want, and that will create stability in the end. I'm absolutely convinced of that. And then on, I'm not in the business of all these words of picking, continuing, or improving, or accelerating, or whatever. I don't like that. I think that this is too serious for that. The United Kingdom has a huge interest on making sure a deal is reached, both economically as geopolitically. The EU has a huge interest to get a deal done. both economically as well as geopolitically. There is so much happening in the world. How can we, as United Kingdom and the EU, not be able to reach a deal? And then I think it is too important to big words on intensifying, accelerating, continuing.
More it doesn't say intensify, it just says let's continue. You wouldn't read too much into that. It's not. It doesn't say anything.
Nobody after the 1st of January, when hopefully we have a deal, will then look back at October and say, did they say intensify or continue?
Well, thank you very much.
Thank you.
In the heat of the European moment, our Maria Tadeo in conversation and questioning there with the gentleman from the Netherlands. We welcome all of you on Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. And Ann Richards is with us with Fidelity International and their Chief Executive Officer. And it is stunning to see the disinflationary tendencies in Europe. We see it in full faith and credit yield. We see it in the five-year break-evens. You are expert in this mathematics. How do you reverse the glide path of disinflation?
Well, you're not going to reverse the glide path to disinflation until we have a meaningful change in central bank policy, and that is not going to happen anytime soon. So, in a way, Tom, I don't think that's the right question to be asking. I think the question we need to be asking is, how can we take advantage of the environment that we're in order to build towards, to take advantage of the disruption that we've been through, to take advantage of the radical changes we've all had to bring into our business models, to say, how do we build a new and better economy on the back of this extraordinary set of circumstances, because that is the opportunity that sits within our grasp right now. And I think that is what we should all be as policymakers and businesses focused on. How do we not build back as it was before, but build back different to some of these bigger picture things that we know we have to address, whether it's around climate, whether it's around sustainability more generally. You know, these are global inequality. These are things that we should really try and tackle now, on the back of this gift that we've had of ultra low interest rates.
You know, I'm looking at the negative rate experiment coming up in the Bloomberg. I've got a negative interest rate in Switzerland out at least to 30 years as well. When does this folly end? I mean, when do we end with the commercial banking / investment world of negative interest rates, or do you just see it to a Fidelity International perpetuity?
Well, what it means is that borrowing costs are incredibly low. They're incredibly low for governments and they're incredibly low for businesses. And we know that we have to reinvent so much of the global economy on the back of what's happened. We know that there's a huge amount of investment that we need to make into the green economy. We know that there's a huge amount of investment that we need to make in order to bring up income levels, improve internet connectivity, improve education and healthcare systems in large swathes of the world. We should be thinking about mechanisms to take advantage of this wonderful low interest rate policy that we have in order to boost productivity and address some of those challenges that have been endemic and very difficult to deal with in the 10 years since the global financial crisis. And so, you know, I am a positive person. I am a glass half full person. I think that's what we should be thinking about. And I think when you look at the IMF and the things that it's talking about, how we reshape, for example, the world, and where we figure out how we lend effectively to emerging market countries, these are things that we should be talking about really seriously. Yeah. It's an opportunity.
I mean, Francine Ann Richards, you know, being optimistic and being so young, went out and purchased the Austrian piece out 98 years or something, and she's up 44% a year in price from a 110 to a 228 with a yield under 0.5%. Francine, these are bizarre times.
Yeah, when you look at European yields, they're pretty bizarre. But to your point, this is what we should be doing, and this is the rhetoric that we hear from politicians. Politicians are still dealing with a crisis. So, as an investor, how do you choose, or how do you make sure that you put your money in countries or industries that are going through this change, and that are taking advantage of that crazy yield on the Austrian coupon?
So look, I mean, I think you have seen more engagement between policymakers and businesses in the last 6 months, probably more than you've seen in any period in my career, because that understanding is that those of us who are involved in and are controlling to an extent some of the access to capital markets, what we need as policymakers to give us the framework that we can be part of in order to help direct the capital where it needs to be targeted. And very, very simplistically, what I mean by that is, rather than thinking about individual infrastructure projects, for example, can we think about a framework that thinks about the impact of borrowing, where it's then invested, and how we create the framework with the tools to give you the assurance that any money raised is being spent appropriately? How do we pull these things together to then direct the rebuilding of economies and the new building of economies? Maybe less urbanization, maybe more spending on infrastructure going into less urban areas, a more equal economy potentially arising as a result of that. I think that's how we have to come together. And I think it is achievable. I think that is something that, particularly with the leadership the IMF has shown on this, that we could really start to think about at a global level. And I think that would be a huge step forward if we could do that.
And thank you so much. Anne Richards there, Fidelity International Chief Executive Officer, joining us for the last 40 minutes. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom, don't count on another pandemic stimulus package before the election. House Speaker Nancy Pelosi told MSNBC the two sides are far apart on worker safety, school funding, and a strategic testing plan. Meanwhile, Treasury Secretary Steven Mnuchin says Democrats don't want to give President Trump something he can brag about in the last weeks of the campaign. And Democratic presidential candidate Joe Biden raked in a record $383 million last month. That broke the mark the Biden campaign set the month before. The massive fundraising hauls have helped Biden and the Democrats reverse President Trump's one-time financial advantage. And in France, President Emmanuel Macron has imposed a curfew in Paris and other major cities. That extraordinary step is part of a series of new measures aimed at containing the spread of the coronavirus. Rising infections in France have started to fill up hospital beds. Billionaire Robert Smith will pay about $140 million to end a 4-year U.S. tax investigation. Bloomberg's learned that Smith also will have to admit wrongdoing. The probe focused on assets held in offshore tax havens. Smith is CEO of private equity firm Vista Equity Partners. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thanks so much. Like Goldman Sachs, it will be fascinating, the distinction between Goldman Sachs and Morgan Stanley and everyone else. Coming up, Devin Ryan will join us with JMP Securities with Morgan Stanley to release this morning as well. Futures a negative 35. The VIX out almost two big figures, 28.28. Risk off. Stay with us. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us work and live has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London, Tom Keene in New York. Just really extraordinary news flow today. Right now, we want to get to global Wall Street and really the transformation of Goldman Sachs, and with Morgan Stanley out this morning, what James Gorman has done at Morgan Stanley. Devin Ryan joins us with JMP. Of course, it's Sandler O'Neill for years. Devin, thanks so much for being with us. Here's the simple drill. Morgan Stanley, last 10 years, coming out of a horrific crisis. We know what the Japanese did, up 8% per year. Goldman Sachs really lags, up 3% per year. As a combined entity of entrepreneurial innovation and Wall Street, are Goldman Sachs and Morgan Stanley in a new regime where we can expect much better shareholder return?
Tom, it's a great question, and I think both Morgan Stanley and Goldman Sachs are two of the firms that are changing faster and more than, call it, the broader financial system. And so I think that's putting them in a good place for the future. Financials is a world highly regulated, so it moves somewhat slowly. So these changes take years to play out. But Morgan Stanley, I think, is further along in their journey. So if you look back, you mentioned over the last 10 years, they bought Smith Barney. They more recently bought E-Trade and now Eaton Vance. They're really shifting dramatically towards asset and wealth management, fee-based, steady, capital-light businesses, away from the mix towards the trading and capital markets. I think Goldman's doing the same thing. They're doing it somewhat differently, and they're in an earlier stage of that.
You know, I saw James Gorman in Whole Foods last night. We were fighting over avocados. I'm kidding. But if I saw James Gorman in Whole Foods, Devin, what I'd ask him is about what's next after E-Trade, after Eaton Vance, and really about the continued percolation of Morgan Stanley taking Gorman best practices internationally. Is that feasible?
Taking it internationally, I mean, I think they already are international. And so the opportunity is to take the network that they've built internationally, the distribution capabilities, and even some of the product capabilities, and connect more into that. So I think that's a big part of this Eaton Vance deal, where Eaton Vance has a terrific presence, but they're primarily in the U.S., and they also have some product that Morgan Stanley doesn't have.